There is a lot to like. I mean, this basically all comes down to the resiliency of the economy.
We expect the U.S. economy to continue to expand, to continue to grow with solid momentum.
Eventually, we do think that an economic contraction plays out.
Overall, the economy is performing like it doesn't really get impacted by kind of these swings in rates.
I think the bond market rally and the equity market need to happen in tandem, and they need to make sense rationally for what's going on in the economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get your trading day started live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now with your equity market on the S&P 500 slightly negative. We're down 0.1%. This has been a grind. Just about squeezing out the 41st all-time high of the year so far on the S&P 500. You can thank Nvidia. You can't thank the data. Consumer confidence falling by the most in 3 years. The share of people saying jobs were plentiful declining for a 7th month. The share of people saying jobs were hard to get, the highest since 2021. The difference between the two, Lisa, continues to narrow.
A lot of people focusing on this as potentially a forward-looking sign of just how weak the labor market actually is. Andrew Hollenhorst coming out pretty much on cue from Citigroup talking about this. My question is, we're getting so many mixed signals. The way that the market read this was, maybe this gives it an opening for a 50 basis point rate cut in November. Good for risk. I mean, this sort of is where we have been for quite a while.
When it comes to the survey, now you see consumers really worried about the labor market. That metric you're talking about, closely watched by economists. It's the longest streak that we've seen this narrowing since the Great Recession. So there's a lot of concern about this exact metric. But then you look at some of the details and you see consumers are also still worried about inflation, but they're still spending, especially on services, the part of the economy that has obviously been hard to tail back.
As AMH really laid out for you, this is consistent typically with recession-type conditions. But then you hear from Dana Peterson of the Conference Board, who said the deterioration across the index's main components likely reflects consumer concerns about the labor market and reactions to fewer hours, slower payroll increases, fewer job openings, even if the labor market remains quite healthy. That word healthy still getting knocked around.
But we've heard that from everybody. I mean, we heard that from pretty much anyone who watches the labor market. This doesn't look like some sort of massive downturn, like you're on the brink of some sort of significant recession. So what does the Fed do with this? And at what point do further rate cuts of a 50 basis point end up igniting, I don't want to say inflation, but something kind of like that.
Do you want to talk about inflation?
Well, I don't know that it's actually a preeminent concern, but there is a feeling that we do not know where it's going to stick. And there is a feeling in markets that there is anxiety that maybe we have overlooked that. Mickey Bowman kind of underscoring that, saying inflation's still very much a concern, and maybe giving some life to this steepening in the yield curve, gold at a new all-time high, some of the other types of moves like that.
Or it's politics. And Paul Donovan talked about this yesterday in his note ahead of the survey, saying how when it came to the Michigan sentiment, that was entirely due to Democrats' optimism. Democrats might be uniquely living in a better economy. More likely it represents political polling. A lot of criticism of these surveys is that depends what side of the aisle you sit on.
We see this in UMich all the time. Things are super polarized in this company. On the inflation point, gold's at an all-time high. The curve has been steeper, much steeper over the past week. We started to see some action in the likes of Rio yesterday. Rio Tinto having a nice rally. Caterpillar having a nice rally off the back of rate cuts in China. Dollar China, the offshore yuan, dropping below 7 for the first time in 16 months. Another rate cut out of China overnight.
Obviously a sign that there is an attempt to stimulate an economy. What this is and how you describe it, very much contentious depending on who you are. Some people saying this is a bazooka. China Beige Book's Shahzad Kazi coming out and saying, in no way is this a bazooka of any kind, saying more likely this is actually a recognition, an official recognition by authorities that this truly is a weak economy and that Q3 or GDP probably is going to come in somewhat weak, and acknowledge that in real time.
That's why a lot of people expect a lot more out of Chinese authorities in the months ahead. Your equity market on the S&P 500 as we speak, just recovering just a little bit. We're still down by about 0.1%. In the bond market, yields across the curve, particularly at the front end of the curve yesterday, lower. Today, a little bit higher, up 2 basis points, Lisa. The 10-year, 375.
We do have a bunch of auctions coming up. To me, this question of how far can the Fed cut and will they respond to some of the data that we've seen, including that differential in the labor market that you were talking about, John, is really interesting. The fact that you have more than a 50% chance of a 50 basis basis point rate cut in November when a lot is yet to be determined is fascinating to me and shows how you give them 50, they want another 50. It's sort of like parenting.
Don't you think what separates the bulls and bears right now is just jobless claims? And a lot of people who think that maybe you shouldn't be long risk are looking for the labour market to deteriorate. Andrew Hoddenhorst City. The people who think you should be long risk think the labour market's going to hold up. Jobless claims are south of 220. It all seems to come down to one data point, which makes me wonder how vulnerable we are. The conversation we'll have in just a moment is whether we're vulnerable to another August 5th taking place in this equity market.
That the next non-farm payrolls is going to end up being incredibly volatile and a catalyzing moment for markets between the bulls and the bears. This is going to be the determining non-farm payrolls report until
everything gets settled.
Until it comes out and it's, 142.
Wait for the next one.
And then wait for the next one. It's going to decide everything. And that's basically the cycle we've been in.
That's been the last 2 months or so. Coming up on this programme, Dean Kerner, the macro risk advisors, on the risk of another August 5th. OECD chief economist Alvaro Pereira on why the US economy can avoid recession. And former senior US intelligence official Norman Rule as Hezbollah targets Tel Aviv. We begin the hour with stocks just off all-time highs, thanks to another boost from Nvidia. Recent gains masking some vulnerability in the US economy as consumer confidence fell by the most in 3 years in September. Joining us around the table, Dean Kerner, the macro risk advisors. Dean, good morning to you, sir.
Morning.
You've written about it in your note. Let's talk about it. The risk of another August 5th. How big is that risk?
Well, these are always tail type events, but we just saw one. And I think, what I try to do is learn from what the market tells us. And that was just, quite an asymmetry. And I think gapping out of prices is something that we see time and time again in markets, even liquid markets. And, I tend to really live and breathe these anniversaries of events that are volatile and so forth. And 10 years ago in October, the Treasury market had this famous thing called the up crash. It was sort of the inverse of the flash crash, right? And so in the most liquid, most consequential market for assets, the U.S. Treasury market, you're not supposed to have prices gap out, even if they gap up. So that was 10 years ago. U.S. debt outstanding was $17 trillion. It's $34 trillion now. So, it took us 220 years to get $17 trillion in debt and 10 more to get the next $17 trillion. I think that means something. I don't think you can look at the Treasury market as a stabilizer as you once did. It itself is sort of part of the risk dynamic of the market.
It's a source of risk.
It can be. Now, certainly, as you guys were outlining, the Fed is kind of coming to the rescue. Your WIRP page on Bloomberg, I can't imagine how many times that's being summoned. As Annmarie said, you've got 1.5, Fed eases priced into November. It's going to be a very interesting meeting. It's going to come 2 days after the election. If Trump wins, I'm sure all these consumer confidence numbers will flip.
For the Republicans, anyway.
Exactly.
Yeah.
So we'll sort of get, it'll be a great economy all of a sudden. But look, when I step back and I just look at the sources of vulnerability, I do think August 5th is consequential because a 3% down move in the S&P doesn't happen all that much, but a 65% up move in the VIX on the back of that should tell us something about the fabric of risk taking. And you've talked a lot about the economy. Ultimately, asset prices in the economy, they're going to sync up over the long term, right? But look at China, right? We obviously have a very weak economy, but they goosed asset prices quite a bit. Look at BABA and JD. I mean, just gigantic amounts of call buying yesterday, huge rally in ETFs like the FXI. And so over short periods of time, at least for me, the financial economy matters quite a bit. Positioning matters quite a bit. And I just try to take what asset prices tell us, and I look at things like gold. To me, gold it occupies a very important place in the portfolio right now. It's scarce. It's in demand by central banks. And it's got this, what I would just call anti-correlation aspect or characteristic to it, which is on the worst days for the S&P, gold hangs in there. That's a very important property to have in your portfolio right now.
Before we get into gold, there's a lot that I want to unpack, in particular about the fabric of risk and how bonds are very much a part of that in a new way. They don't act as the same kind of stabilizers. Is there any way to quantify how much and how new this is, that risk lies with bonds as much or maybe, even sometimes more than in the equity space?
Let's first recognize that I think in a true pinch, bonds will take on their risk-off characteristic. In other words, if you got a absolutely systemic shock where the S&P was down 25%, I think bonds are going to rally. But in the non-truly systemic event, you've got a couple things that are problematic for bonds. The first is, and I think we're largely past this, is 2022, the rate hiking cycle, right? We had to do something about inflation. They were behind. They had to go fast. You had this joint drawdown in stocks and bonds. And the second, as I was alluding to with John, is just the sheer size of the supply and the debt outstanding. And sadly, no business plan, right? I mean, if the U.S. government is a company and you've got this debt outstanding, you'd really hope that the politicians would be talking a little bit more sensibly. You guys ran a story yesterday about some of the stuff Trump is throwing out there. I think it's, just with the letting the tax cuts continue to go, and then no taxes on tips and so forth, no taxes on Social Security, you've got another $11 trillion. Now, he's throwing a lot of stuff out there, as is Harris, but there doesn't seem to be an adult in the room with respect to this just incredibly consequential asset class.
To take that a little bit further, are you saying that heading into November, the big risk potentially for markets is a wake-up call almost about this? Because we've been hearing a lot about the deficit, and it hasn't really mattered. I'm not going to use Liz Truss's name, but there is this fear that maybe you do have some sort of reaction in the bond market in a real way on the heels of the election.
Right. So the U.S. is still the global reserve currency. It's not going away. That's not the U.K. So the Truss moment was a big deal. I think we should look at it and certainly at least try to learn from it. I don't think it's that, but I do think that the buyer base of the U.S. Treasury market has evolved quite a bit over the last, decade or so. The fundamental owner is not necessarily the Chinese central bank anymore. Those holdings are down 40-odd%. You've got basis traders, folks trading this arbitrage between cash and futures. I don't think you want to lean on relative value hedge fund traders as the key chief component of the demand at your auctions. So it does worry me. Inflation is coming down. The cost of debt is coming down. But these interest costs are punishing. And it's just hard to me to imagine a scenario in which we grow our way out. Maybe there's some gigantic peace dividend coming from AI, but I certainly just can't help but look at, I'm a deficit scold, as Paul Krugman used to say. I'm worried. I just think it's something we have to pay close attention to.
Dean, where do you think the volatility will come around the election? Everyone, is nervous ahead of it and don't know how to potentially trade this. But after, especially when you have places like Georgia saying that now they need to hand count every single ballot, it may be days or weeks until we know who wins this election. Yeah, it's so interesting to look at the Chicago Board Options Exchange, in their voracious appetite to make more money, have given us more options listings. And so you have options on the S&P that expire November 5th, Election Day, and November 6th. Such granularity that you can look at the differential in prices. And so we look at this metric called implied volatility. It basically allows us to score the price. And the difference between November 5th expiry and November 6th expiry effectively implies that the S&P could move 2.5% or more on November 6th, the day after. Now, I think there's a couple ways to look at it. One, if you go back to 2016, you'll remember when Trump was ahead and it was coming to everybody's recognition that he was going to win, the S&P was down 4 or 5% overnight and then rallied strongly the next day. So people kind of came around to, wow, this guy's going to cut taxes, the chaos. It might be good for markets, right? When I look at the differential in prices now, my conclusion really is a learning experience from episodes like Brexit. And John will remember quite well, liquidity just dries up. No one wants to be short volatility, this convex insurance contract, downside puts as an example, ahead of something that you just can't price. The setup, I think kind of on both sides, is to call foul on this thing. It's not a good thing. And so when you pull back liquidity from a market, the clearing price goes up. There's going to be less supply of insurance, of options to the marketplace, and that's going to drive up the price. And I just think that's another thing we're supposed to worry about in this kind of theme of the gapping out of prices.
I want to put a bow on this. You're really questioning the risk mitigation characteristics of treasuries going into the election. Are you saying that for the people coming on this program right now pitching 60-40, we should be pitching something else?
Well, I think we should be really looking at gold. Gold is this trending asset. It doesn't have the same consistent correlation characteristics to treasuries. Again, in a true risk-off, a big one, I do think treasuries are going to rally. Where else are you going to go?
Sure.
But I do think that the supply is an overriding issue, especially for the back end, right? The front end, yeah, that's coming down. Now, in some ways, the market's already there, right? We've already priced out sort of 8 more cuts out to the end of 2025. But the back end, the 10-year, the 30-year, I think these supply dynamics are going to be a headwind for the traditional risk on, risk off, the shock-bearing characteristic of treasuries.
Gold at all-time highs. Dean, deeply thoughtful, as always. It's good to see you, sir. Dean Kerner there of Macro Risk Advisors. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Heckes. Hey, Yahara.
Hi, John. Unicredit CEO Andrea Orcel says he won't seek a board seat at Commerce Bank. The Italian bank has built a major stake in the German lender, saying a full takeover is an option, even as the German government strongly opposes the move. Amid the intense battle for the future of Commerce Bank, the lender has appointed a new CEO. Bettina Orlopp will take over, leading the 154-year-old company through one of its biggest challenges. Sam Bankman-Fried's ex-girlfriend and co-conspirator in the FTX fraud, Caroline Ellison, has been sentenced to 2 years in prison. The judge saying Ellison's help in the conviction of Bankman-Fried was remarkable and praised her testimony, but noted the case was one of the most serious financial frauds ever committed and that her cooperation can't be a get-out-of-jail-free card. Like Bankman-Fried, Ellison was ordered to forfeit $11 billion as proceeds of the crime. And the Trump campaign says it's been briefed on, quote, real and specific threats by Iran to assassinate the former president. A campaign spokesman says a representative from the Director of National Intelligence told Trump about the plot. But there's no indication Iran's efforts are linked to the 2 recent attempts on the former president's life. Ryan Ruth, the suspect in this month's incident at Trump's Florida golf course, was charged yesterday with attempted assassination of a major presidential candidate. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, taking America first to new heights.
We will set up special zones of federal land with ultra-low taxes and regulations for American producers. These will be ideal spots for relocating entire industries that we've taken in from other countries.
That conversation up next. Bloomberg's undercurrent just around the corner. Live from New York City this morning. Good morning. Equities closing at all-time highs just about in yesterday's session. This morning pulling back by not even 0.1%. In the bond market, yields resume their climb, up by 2 basis points on a 10-year 3.75. In the commodity market, check out gold. 4-day winning streak through yesterday, all-time highs, pulling back just a touch, just about unchanged on the session. Dean Kerner of Macro Risk Advisors on the program just moments ago. If you're worried about risk into the election, maybe Treasuries won't provide you with those risk mitigation characteristics. Perhaps you should look elsewhere.
And he's talking in specific about gold. Yes, really, gold. There is a question here about going forward, whether this is the new uncorrelated asset class, especially with central banks buying and potentially, I don't want to say concerns about inflation. Whiffs of inflation was something that you used this morning, but a sense that maybe it's going to be stickier than people think.
Look, we're going to talk about it more throughout this morning. It's a trend of the past week. Whether it continues, I don't know, but I think we have to identify the current trend. It's gold. It's things tied to China. Base metals, we saw it with copper yesterday. You saw it with the miners, Rio. You saw it with the tech firms, Baba. Are things starting to turn in China? I've got no idea. I'm just looking at the trend of the last week and trying to work out if it continues.
And if you think about it, China's been exporting deflation. If they start to actually grow, then could you get a different kind of story? Not necessarily inflation, but a stabilizing in that deflationary force.
Gold just off record highs. Under surveillance this morning, taking America first to new heights.
The centerpiece of my plan is for a manufacturing renaissance, which will be a 15% made in America tax rate. And we will set up special zones of federal land with ultra low taxes and regulations for American producers. These will be ideal spots for relocating entire industries that we've taken in from other countries. They're going to come in at levels that nobody's ever seen before.
So here's the latest this morning. Donald Trump pledging to recruit foreign companies to move their manufacturing operations to the United States using tax incentives and the threat of tariffs. Kamala Harris will outline her views on the economy in Pennsylvania later on today. Joining us now from the nation's capital, Bloomberg's Anna Karen in Washington, D.C. And how different is what Trump is proposing from what we already have?
Well, it's very punchy, and as you say, John, it does take it to another level. On the one hand, former President Trump talking about bringing corporate taxes down to 15% and saying if you don't make your goods in the US, you will be facing tariffs. Now, that is a new dimension to where the trade story has been developing in recent years. Former President making the point he thinks thousands of businesses will move here and trillions of dollars worth of wealth will be accrued in the US as a result. But the economists watching this yesterday, when I spoke to them, made the point that on paper that would prod more production to come to the US, but the flip side is that it could also stoke another round of protectionism as trading partners retaliate, and there could also be an inflationary aspect to it as well. So it's kind of a double-edged sword, and don't forget, of course, it depends on the balance of power in Congress and whether or not President Trump could get the corporate tax rate cut through, because that's obviously a big part of this equation that he's offering.
Yeah, that's the carrot. He also talked about appointing a manufacturing ambassador who the sole task would be to go around the world and basically try to steal other countries' industries. What industries is he going after, Enda?
Well, again, we'd have to see the exact details and mechanics of this. Already, some industries in the US are fairly well protected. There are tariffs on industries. The auto industry, for example, already has a lot of its production based here. So the details of this would remain to be seen. We'd have to see how China would be treated in this as well, of course. But I think the broad picture is, yes, it adds to the idea that the US, again, will be putting a focus on rejuvenating manufacturing here. That's been a theme in the Biden administration, as you know, through the subsidies and grants for green energy in the chip space. President Trump as well, when he was president, was promoting manufacturing here, and this would now appear to be taken to a new level. The issue, though, is when you speak to both business people and economists watching this, on paper, that sounds okay, but the big question becomes, how do key trading partners retaliate, and how will that impact American businesses trying to do business around the rest of the world too? So, as I say, very much a double-edged sword, and a lot remains to be seen in the detail of how this will play out.
We're still waiting for a lot of details from both sides of the aisle. We're going to hear from Kamala Harris today. I imagine she's going to talk about a, quote, opportunity economy. She continuously talks about this idea. But what is that? What do you expect her to say today in Pittsburgh?
Certainly a lot of anticipation for more detail on Vice President Harris's economic policies. Today, the speech that Vice President will detail will, on the one hand, speak about the need to protect workers' wages and benefits, but on the other hand, also make clear that the Vice President is willing to talk and do business with big company leadership. She's making it clear she's willing to get the balance right between labour and capital. The theme of this speech, again, will be around incentives, pragmatic incentives for manufacturing. Of course, the speech will be delivered in Pittsburgh. That's obviously very symbolic. And of course, we're told, my colleagues have reported that the Vice President is planning a lengthy document on her economic policies as well. And I think a lot of people will be waiting keenly to see what's in that. We have had detail, of course, so far on child tax credits, on the measures, what's described against price gouging, measures to promote house building, for example. But there's still, I think, a view out there that more detail is needed on the Vice President's economic policy, and today might be the first step in getting some of that.
We'd love some more detail. Enda, appreciate the update. Thank you, sir. Enda Karen, down in Washington, D.C. Potentially some more detail a little bit later.
Yeah, the question I have, and this has been something that's been true for both candidates, is what will the market cling on to? And I'm talking about companies as well, C-suites, that are not necessarily taking action. That's where the lack of clarity is, not just on what the plans are, but what's feasible, what's actually going to get through, because a lot of this is expected to get left on the cutting floor.
Do these campaign promises translate into legislative reality?
And if they do, what's the bigger risk, the deficit or potentially the growth profile?
Up next on this programme, a man tasked with making a call on 2025. I'm not sure how you do that without understanding the outcome of the election, but they're having a go. The OECD chief economist Alvaro Pereira, as the global economy looks to move beyond peak inflation. That conversation just around the corner. Equity futures on the S&P 500 this morning. Slightly softer, just a little bit negative, no drama. We're down by not even 0.1%. This is Bloomberg. Adding some weight to the rally in yesterday's session, up by 0.2% on the S&P 500, pulling back just a little bit this morning. We're down by 0.06%. On the Nasdaq 100, down by 0.2. The Russell just about hanging in there. If you switch up the board and get to the bond market, the 2-year versus 10-year, that yield curve gets more and more interesting. The difference between the two, the most positive since June of 2022. We're looking at 22 basis points, Lisa, on the screen right now.
And part of it is because of the precedent that in some ways the Federal Reserve seems to have set, at least as perceived by the market, that a 50 basis point rate cut, the bar for that isn't that high. Austin Goolsbee suddenly representing the mainstream of the Federal Reserve, regardless of some of the others that are coming out and trying to temper the message. But the fact that yesterday, the details of that consumer conference board, just not good, but as justification for another 50 basis point rate cut potentially in November, at least it's seen by the market.
When you read the details of that and then listen to what Governor Mickey Bowman had to say, the hawks and the FOMC sound really offside relative to some of the incoming information. Listen to this quote. I continue to see greater risk to price stability, especially while the labour market continues to be near estimates of full employment. The takes on the labour market just aren't that constructive elsewhere compared to what Governor Bowman's talking about in the Federal Reserve.
To put some details on this, the consumer confidence read from the conference board yesterday coming out with a differential of those saying that jobs are plentiful and those that are scarce or hard to get fell to 12.6, which was the lowest reading going back to March of 2021. It is below where we were in the pre-pandemic era after 2017. There is a real question here about how much you are seeing deterioration that isn't being quantified with some of the headline numbers. And Andrew Hollenhorst of Citigroup coming out and saying this is the reason why we are concerned still about a recession.
Typically not what you see before upturns in the economy. Typically what you see before downturns. People start to get anxious about the jobs market. They pull back on spending. That's what you'd expect. That's what would be, I think, intuitive at this point about what would take place in the next few months.
That said, we've seen head fakes before. The data's been challenged in terms of how accurate it is. Confidence is a fuzzy thing. Ask University of Michigan. There's a question about what exactly is influencing it. Annmarie did a great job highlighting the political aspect of this. There's a good degree of uncertainty in the delta between manufacturing, between services, between lower income and higher income. These are the widest gaps we've seen in a very long time. And so it's very hard to get a sense from some of these averages about what exactly it's reflecting.
Let's pick out a word you used, confidence. What can China do to restore confidence? Check out the currency. Dollar China, the offshore yuan, breaking 7 for the first time in 16 months following a rate cut overnight. Under surveillance this morning, China cutting its one-year loan rate by the most in history as the country kicks off a sweeping stimulus program. The PBOC slashing its medium-term interest rate by 30 basis points with further policy moves widely expected.
The key is, what are those policy moves to ignite demand? And we've talked about this extensively. We talked about it yesterday. Essentially, you can lead a horse to water, but can you make it drink? Well, you got to make it thirsty enough. And the way to make it thirsty enough is to actually have confidence in the economy. What you're seeing is even with borrowing costs that are historically low for China, with yields that have fallen to record lows, you still are not seeing a big uptick in borrowing. This from the China Beige Book. This, to me, is a sentiment shift that we have to still yet to see.
And what you said earlier was exactly right. It's clear that Beijing knows they're not going to be able to hit their GDP target, so they're trying to do everything they can. But is this the bazooka? It's not, unless it's followed up with that fiscal stimulus that's so desperately needed in the real economy. When you look at the surveys coming out of China, and Jonathan, you've made this point. Does China need to wait till November 5th to decide how much they need to use that fire hose?
How much ammunition do you need to deploy based on the outcome of the election in November? We spoke to Goldman Sachs yesterday, who said this may have a bigger impact on the equity market than it will on the broader economy. We saw it in the stock market yesterday. All of the China proxies, if they were listed here, in Europe, elsewhere, all rallying big time off the back of these moves.
With the Plunge Protection Patrol, or basically support to equities, but also, there's got to be a feeling where everyone was wondering, why is this administration of China holding off on stimulus when you've seen growth that is just failing to perform? And the point that China Beige Book was making is maybe this is the first step in their acknowledging the reality, which is a lot weaker than what they've been saying. And if they acknowledge the reality, that alone might give people confidence that maybe they're looking more at the economic side of their mandate, other than sort of a more ideological one. And that might give businesses more confidence.
Certainly gave stock traders a little bit more confidence. I want to get you an update on a big negotiation taking place at the moment. Union negotiators for Boeing workers bulking balking at the plane maker's 30% pay raise proposal, maintaining their demand for a 40% increase. Boeing saying it will offer additional time for the union to schedule a vote among members. Union negotiators saying that they are ready for mediated or direct talks with Boeing.
So they're giving them a lot more time. So potentially you can have this best and final, maybe be some wiggle room around there. What caught my eye this morning was that internal Boeing survey. You know, the FAA has been looking into what's going on there. Many factory workers still felt pressure to prioritize speed over quality months after that midair blowout one of the company's jets. So you see what is going on in the factory floor, and then you potentially try to think about who has the leverage here, because time is of the essence.
Have we even worked out what the problem was initially? I mean, we have a new CEO. We're still trying to get a sense of exactly how deep these problems go. How big of a piece is this? Some of the complaints that they have coming out of the worker base.
It's a nightmare for incoming leadership. You want to really go out there and lay out your strategy in the next 100 days or something, and you're just sort of patching up leaks here, there, and everywhere, and those leaks are getting bigger.
Can you imagine being in that role?
Oh, brutal.
Coming in, it's like, I'm going to be the white knight. And then you're sort of like, union strike.
At least the bar is low enough, right? And the bar is pretty low for the incoming CEO. Boeing just a touch negative in the pre-market. Let's get to the latest in the Middle East. Israel and Hezbollah intensifying their aerial attacks. Israel intercepting a ballistic missile bound for Tel Aviv in the first instance of a Hezbollah projectile reaching the center of the country. The IDF saying it struck the site where it was launched in Lebanon.
Another red line being evaporated given the fact that the Israeli military is saying it's the first time a projectile fired from Lebanon was able to reach Tel Aviv. The big question now is whether or not we would see a ground invasion. And you have to look at what the defense minister of Israel was doing yesterday, posting pictures of him inspecting Israeli troops simulating combat in Lebanon. Potentially, this is going to be the next stage of this conflict.
To most uninformed observers, this looks like a war. Are we suggesting that's the only thing separating this from being an all-out war, a ground invasion?
It feels like it is already a war. I think it depends on how people want to actually characterize it with language. They would say potentially this is a conflict. They're worried about a wider war, but this is a warlike conflict, and potentially the next step would be a ground invasion. I think at that point, you cannot have officials backing off of characterizing it as such.
I'm looking forward to speaking with Norman Rule. One of the big distinguishing features to me is, what are the ultimate goals? Is it just simply to push back some of the Hezbollah fighters, to bring residents back to the north of Israel? For Hezbollah, is it really to bring some sort of ceasefire with Gaza? Or is this something more significant about eradicating threats that they perceive on either side? To me, that is what is going to distinguish a prolonged conflict from something that is short and specific. And that, I think, is what a lot of people are watching.
Norman Rule, about 10 minutes away. Let's turn the page to this story. The OECD releasing its latest economic outlook, expecting global GDP to stabilise with continued disinflation. Central banks still have room to cut rates, but debt sustainability is still a top issue. Joining us now, Alvaro Pereira, Chief Economist at the OECD. Alvaro, welcome to the programme, sir. I want to begin with the United States and get to some of your forecast on the US for GDP. Growth in the United States projected to slow but be cushioned by monetary policy, with growth projected to be at 2.6% in 24 this year and 1.6% in 25. Two-part question. Why the slowdown, one? And two, why do you think we can actually stabilise around 1.5% GDP in America and not go to someplace worse?
Well, good morning. Great to be on the show. Well, first of all, I think it's important to realize that we're talking about a very robust U.S. economy compared to the rest of the world, because we come back to China. China is slowing down quite significantly. We also think that Europe is not doing as well as it could, and other parts of the world are not doing so well. So under the circumstances, knowing that we had a huge pandemic and a big energy crisis, the United States is doing fairly okay. So what explains the slowdown? Well, first of all, there's a statistical a carryover issue, which basically the last quarter of 2023 was stronger than we expected. It has a statistical carryover, and so that explains part of the slowdown. And so if you take into account quarter on quarter, we would forecast, 1.9 for the slowdown will be from 1.9 to 1.6. But the second issue, why is this happening? Well, first of all, it has to do with consumption. And so a lot of people had savings during the pandemic, and they are running out. And so this is not so good for consumption. So there's slowdown in consumption. There will be a slowdown in government consumption, which is welcome because we think that both the deficit and the debt in the United States we should go back to fiscally prudent policies. So I think it's very important to go there. And obviously, there's also an issue regarding exports and investment. But we think that main reasons why the United States will continue to do well is because it continues to be a very dynamic economy compared to other parts of the world, even though certainly the slowdown is explained by the consumption, both of the government and the individuals.
You make a great case for why we could see something of a slowdown in the U.S., but still why the U.S. is a better growth trajectory than, say, Europe. So then why did you have the Euro region actually increasing to 1.3%? I know it's downgraded from your previous estimate in 2025, but where are the accelerators to get us away from what we're seeing now, especially given some of the trajectory in the industrial base in Germany?
Well, Germany's almost stagnated this year, almost close to zero this year. We see France doing a little bit better, partly because of the Olympics, but partly because of consumption as well, 1.2%. And we have Italy doing so-so, Spain much stronger. Next year, we think that there'll be higher growth in Europe, and not fantastic, we're talking still 1.3%, but we see higher growth because we think that the recovery that we see in terms of purchasing power will continue. So because wages are recovering, and so I think this will have an impact on consumption. But we also think that some investment will take place, partly linked to the resilience fund that were spent by the Europeans on infrastructure projects. So this will help a little bit. So that's what explains a little bit better performance of Europe, but certainly not spectacular growth rates.
All things being equal, where is the growth really going to come from? Where is the growth engine, the new growth engine in Europe at a time where some of the challenges for Germany are structural, especially at a time where Chinese growth has been unreliable?
I think you just mentioned something that is absolutely essential. Part of the problems with Germany right now are cyclical. So it's coming out of the energy crisis, and we know that there's been a downward trajectory for part of their manufacturing, but also services. And also because consumers in Germany have been very prudent, so they've been saving more than other parts of Europe. But there's also structural issues. You mentioned something that is absolutely true, which is competition with China, and particularly in manufacturing. And there's less demand from China as well for German manufacturing, so that is having an impact. But also there's another issue that I think is important to highlight. We think that Germans should focus on, first of all, improving their infrastructure, especially on digital infrastructure. They are lagging compared to other parts of Europe. But in particular, it's time to go back to reforms in Germany. There's many competition-friendly reforms that are needed. There's too many barriers to services in many parts of the German economy. It's still too difficult, too much red tape around, and we think this is having an impact. In fact, we calculated what's the impact of all this, and we say that for the OECD economies, in order to be with the best practices, economies like Germany could increase growth by 3% over 10 years if they would do this type of reform. So besides the structural and the issues linked to China and the structure of the economy, we think that it's important also to go back to reforms for Germany.
Well, let's talk about China. The PBOC out with another move today. Do you think any of this is going to help spur the Chinese economy?
Well, we are forecasting 4.9% for this year and 4.5% next year. This was before the stimulus. But I don't think that there'll be a huge change in the forecast right now for two reasons. We know that their exports, Chinese exports, are doing fairly well. In terms of manufacturing in particular, they're doing fairly well. But consumption continues to be a bit subdued in China. So this could help. Some of these measures could help a little bit. But we think really the main ailment of China continues to be high debt, private debt. So remember, private debt is there, about 170% of GDP. It's mostly quasi because it's SOE debt, but it's quite private debt. And on top of this, we know that there is a very large real estate market, much larger than most economies. And so there's some adjustment that will have to continue. And so the question is whether these measures will be able to help demand or not. It's a question mark that we'll see in the next few months. But to be honest with you, if you look at the historical examples of other countries, when you have a big real estate adjustment, very often it takes a bit longer than authorities would like.
Alvaro, appreciate the update. As always, sirs, thanks for joining Bloomberg. Alvaro Parada there of the OECD on their outlook for 2024 and 2025. In this, just another report suggesting the US is okay, robust, the UK doing all right, Germany the weak spot. Every single report that looks like this, Germany the weak spot.
What I'm really struggling to get a sense of is when will that change? And if that doesn't, then where's the growth engine in Europe? And you can talk about structural or cyclical or whatever you want, but what's on the other side of this and how different does that sort of make the balance of power in the euro region?
That's the latest from the OECD. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. Warren Buffett's Berkshire Hathaway sold another $863 million of Bank of America stock over the last 3 trading days. That brings Berkshire's stake to 10.5%. The firm needs to disclose trades in Bank of America within days for as long as it owns more than 10%. Bank of America shares fell 1% yesterday and are down 10% since Berkshire began reducing its holding aggressively in July. Meanwhile, Volkswagen and unions are starting negotiations today over wide-ranging cost cuts. Volkswagen plans to potentially close factories in Germany for the first time as sales slow. The move's coming after the carmaker scrapped decades-old job protections earlier this month. The powerful union backing the workers, IG Metall, has pledged to strike if VW sticks to its cutback plans. And the New York Post is reporting Nancy Pelosi's husband sold more than $500,000 worth of Visa stock less than 3 months before the company was sued by the U.S. Justice Department. The DOJ filed federal antitrust charges against Visa yesterday, accusing the company of illegally monopolizing the debit card market. At the time Paul Pelosi sold Visa stock, there was no public indication that an antitrust lawsuit against the company was imminent. That's your Bloomberg brief. John?
Yahara, thank you. When are we going to do something about all this?
You mean have sort of managed accounts that they can't touch?
Let's just put it this way. I don't know what happened on this specific instance. The appearance of a conflict of interest is a problem. Say it again. The appearance of a conflict of interest is a problem.
If you knew that I had done that, can you imagine? I mean, if you knew that I'd accessed information and sold them, we're not allowed to, and we shouldn't be allowed to have.
How can the standards be higher for journalists than members of Congress?
We are the standard bearer of none.
There is a bill floating in Congress called the Ethics Act. Yes, but over the summer you did see a bunch of senators actually take this up and say we need to push this through. I don't know if it'll ever happen.
Watch this space. Up next on the program, a diplomatic solution remains elusive.
Too many on each side of the Israeli-Lebanon border remain just full-scale war is not in anyone's interest. A diplomatic solution is still possible.
Norman Rule, up next from New York. This is Bloomberg. Stocks on the S&P 500 pulling back by, let's call it 0.1%. In the bond market, yields on a 10-year higher by 2 basis points, the 10-year 3.75. Under surveillance this morning, a diplomatic solution remains elusive.
We've also been determined to prevent a wider war that engulfs the entire region. Hezbollah, unprovoked, during the October 7th attack, launching rockets into Israel. Almost a year later, too many on each side of the Israeli-Lebanon border remain displaced. Full-scale war is not in anyone's interest. A diplomatic solution is still possible.
So here's the latest. Hezbollah firing a missile at Tel Aviv early this morning, and the latest escalation in the region. The Israeli military saying it intercepted the missile, and this was the first time a projectile fired from Lebanon reached central Israel. Norman Rule, a former senior U.S. intelligence official, writing this. Israel will seek to avoid becoming embroiled in a long-term ground war in Lebanon. This could change if Hezbollah successfully uses its largest missiles against Israeli civilian centers. Norm joins us now for more. Norman, welcome back to the program, sir. I keep hearing the same line, that we're on the brink of an all-out war. And I keep sitting here looking at the pictures and the news and ask myself, isn't that already what we have? What is this if it's not a war?
Good morning. Such semantics are of little use if you're catching Hezbollah missiles or Houthi missiles. That's a political comment. That's not something that's a serious statement. This is for all intents and purposes, a war, and it's likely to continue and intensify in coming days.
Norm, will we see a ground operation by the Israelis?
Possibly. The Israeli operations appear to be focusing on intensive airstrikes, perhaps special operations activities, cyber activities, and intelligence-driven strikes. Ground operations risk a costly long-term involvement of Israel and Lebanon. It may follow after a completion of major airstrikes, but I think it's likely, but too early to say.
Norm, you also say the U.S. and its European partners have limited influence over this conflict, and they are going to seek to avoid involvement and are unwilling to employ force to enable diplomacy. What would that force look like to enable that path of diplomacy you're talking about?
Well, for Israel, its goals are to return its population to their homes, and that means cessation of Hezbollah attacks. We have an international peacekeeping force that has been of little use. The Lebanese military is unable to contain Hezbollah. So in theory, if international forces were able to somehow interdict or prevent Hezbollah strikes, that would allow Israel to cease its violence. But this would involve all of these foreign actors in Lebanon, and they're simply unwilling to do this.
Norm, how asymmetric is this conflict? We've heard about the walkie-talkies and the beeper explosions. We've heard about pretty targeted strikes by the U.S. on Hezbollah leaders that have killed a number of senior militants. I'm wondering, from your vantage point, how much does Hezbollah have to return?
Well, Hezbollah has probably lost a generation of its most seasoned leadership. This is irreplaceable experience given their involvement in the Syrian conflict. Hezbollah has lost perhaps a quarter, a half of its missile force, but it has thousands of missiles remaining and missile launchers that remain hidden in civilian areas. But Israel has a strategic advantage. Its intelligence remains, if imperfect, extraordinary. An example being that Hezbollah replaced its missile commander within 1 day of the first commander's death, and Israel was able to kill that replacement within 24 hours, as well as several of his subordinates. Israel was able to destroy the launcher of the missile that was aimed at Tel Aviv within minutes of its firing.
Do we have a sense of exactly what's behind this? And I'm just throwing this out there, but was there a sense that with some of the supply chain disruptions, there were tracking devices that were also kind of implemented throughout? Do we have a sense of kind of how deep this goes?
Yes. Israel has demonstrated for many months a capacity to find, fix, and eliminate Hezbollah's most secretive officials, its most sensitive facilities, and and frustrate many of its operations. That implies a pervasive intelligence picture on the country, which must be terrifying to Hezbollah's leadership, but also demonstrates that Israel has done a very effective job of marshaling resources and personnel on a program that likely took years to develop.
Norm, overnight we heard about the Trump camp being briefed from the Office of the Director of National Intelligence regarding real and specific threats from Iran to assassinate him. What is your reaction to this?
This is a very significant threat, but it comes after many months of Iranian threats to former American officials, private citizens who have been warned that they are being targeted by Iran. And we now have the Iranians, in essence, having perceived that no red line had been crossed, moving up to what they think might be the next red line. Here's the threat that we should keep in mind. Iran often employs unprofessional actors, criminals, Hell's Angels personnel to conduct its operations. These personnel don't have great training, and the weapons they tend to gravitate towards are weapons of mass casualty. My worry, and I have no evidence of this, but my worry is that an explosive would be used to kill the former president. Well, the best chance of getting to the former president would be at a campaign event. Therefore, any threat against the president is hypothetically, or in theory rather, a threat against those who attend his rallies. This is a significant development and shows a collapse of deterrence against Iran, at least in this area.
A shocking note to finish on. Norman Rule, thank you for your time, sir. Former U.S. senior intelligence official. A shocking note to finish on.
Absolutely, considering the fact that Norm is talking about how Iran would go about this and what that would mean, not just for the former president, but his supporters.
Up next on the programme, Sarah Hunt of Alpine Saxon Woods, Tobin Marcus of Wolf Research, Lisa Coleman of JP Morgan Asset Management, and Danielle Hale of Realtor.com. From New York, the second hour of Bloomberg Surveillance. Up next.
I think markets globally are really reacting to the Fed pivot.
The relationship between bonds and equities could be kind of undergoing a shift right now.
For equity markets, this is a seasonally weak period.
You're getting rate cuts in a resilient economic environment, which again, historically is good for stocks.
I'm optimistic now that we might be near the end of this big rotation.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance starts right now with equity futures on the S&P 500 just about unchanged after closing yesterday at an all-time high for the 41st time so far this year. On the Nasdaq, we're down 0.1%. On the Russell, we're positive by 0.2%. Bramo, your equity market, coming into Wednesday, very close to a record.
So how much does this actually challenge the idea that so many people have been raising, which is that if you see growth fall or any concerns about growth, you will see that be a negative for equity markets. Yesterday, the boost that we got was from the potential of a 50 basis point rate cut coming in November on the heels of worse than expected consumer confidence data. So try to square that with some of the market narrative.
So I think the bond market woke up to that. Bond market rallied for about 2 minutes. The equity market woke up to that too. Nvidia changed the story. I wouldn't read into yesterday's gains as this market's seeing bad news is good news anytime soon. I still think bad news is bad news.
It might have to do with where leadership comes from, but this is sort of the key question. How high is the bar at this point for bad news to really have a broader ramification on equity markets that are so skewed to Nvidia? One thing that I think people are increasingly talking about is how this stock market is not the economy and how concentrated the leadership is in the top 10 names. This idea that you could see positive returns or negative returns that are not correlated to some of the macro signals that we're seeing in the broader economy.
Well, we're certainly seeing the concerns, though, in the survey done yesterday. That metric, share of consumers say jobs were plentiful, declined 7th month in a row. And then those that say jobs were hard to get rose. And that gap is really starting to narrow. It's been on a long streak, the longest since the Great Recession, since the financial crisis. And this is why a lot of economists are concerned. And obviously, this is what the Fed has been potentially leaning into.
These are trends typically associated with economic downturns, not robust, healthy labour markets, but yet you still hear that word, healthy, on repeat. I think I have to respect the difference between what I worry about and what the market seems to be excited about. What I worry about is that this market is basically supported by one data point right now, jobless claims, and that we hope layoffs don't start to climb anytime soon. But if they do, you're going to see a lot of bulls turn into bears pretty quickly. 1. 2, what we're excited about seemingly is maybe a reacceleration in growth, prompted not just by the rate cut last week, but easing out of China. And I think you've seen just a little bit of that in the market, cross-asset, over the last 24 hours.
Especially if this is just the beginning, the opening salvos for something bigger from China. If you end up with a bigger stimulus, could that end up fueling growth in a number of global companies? There's also something that Jill Carey Hall was talking about yesterday, this idea of companies investing in physical infrastructure at an accelerating pace. So there are all of these sort of cyclical trends that are kind of coming in to give some hope. But to your point, how big is the gap between a bullish read on that non-farm payrolls and a bearish read? And that, I think, is going to be really a node of uncertainty and potential volatility at a time where people are clinging to data points that may or may not be the deciding factors.
Payrolls, 2 Fridays away. Your equity market on the S&P 500 just about unchanged. On the morning so far, just a bit of relative outperformance on the small caps on the Russell. In the bond market, yields still climbing, Lisa. The 10-year, 375.83.
Question of how high those yields could go. And we've heard a real delta between people who think of bonds as still the ballast of this market, a sort of offset to risk, and those who say, maybe this is a different time. Dean Kerner earlier this morning talking about that was fascinating to me. This is becoming increasingly the source of risk. You talked about the fabric of risk and how typically it's been thought of as equities or riskier bonds. But in fact, it is now potentially even in treasuries, which is a reason why he's looking toward gold. Yes, gold. But there is a question here about whether that 60-40 can still operate in that sphere. We talked about that a lot over the past couple of years. An ongoing question.
Gold just off all-time highs. Coming up this hour, Sarah Hunt of Alpine Saxon Woods. Our market's running with a, quote, all clear ahead signal. Tobin Marcus of Wolf Research on Trump's promise to take other countries' manufacturing jobs. And Lisa Coleman of JP Morgan Asset Management on the headwinds to top line revenue growth. We begin the hour with stocks coming off their 41st record high of the year. Sarah Hunt of Alpine Saxon Woods saying equity markets are running with an all clear ahead signal at the moment. If the economic environment remains reasonably good, we expect to see the broader market catch up to include the mid-cap and small cap stocks. Sarah joins us for more. Sarah, good morning.
Good morning.
Let's pick up on something we talked about just a few minutes ago. Gold's picking up, all-time highs. Base metals did yesterday off the back of these moves from China. We saw it with the miners as well, the likes of Rio. We'll talk to Rio tomorrow morning, by the way. Do you think something's going on here, a pickup in cyclical growth worldwide?
Well, I think that the gold move is separate from the other metals, right? Because gold is also, the central bank has been buying gold. There are the issues about buy gold because it has some stability versus other things. But I think on the other metals, I think that it was a signal from China, because I think that there's been an area where those stocks have not really performed and those metals have not really performed because China was slowing down. So you had this huge run up in copper a few months ago and everybody got all excited because we needed so much copper for AI. But the slowdown in China really took the wind out of the sails of copper prices and also other industrial metals. So I think that part of this is on the back of China's stimulus. So I think that that's sort of where you've got that combination.
Is this a move you chase or fade?
On the metal side, that sort of depends on what happens with the global economy. All of these things are dependent on the global economy, including, what I was writing about mid caps and small caps. You need the economy to do well for that to work. If the economy is going to be okay, then you don't even have to chase the metals. You can see, they will move in, you'll have these little up and down drafts, but then you can say, okay, I feel comfortable investing in that area. If you think the economy is really going to slow and or it's going to actually, be very bad, then I think that it's much harder to look at those things that are economically sensitive.
Is what you're talking about very bad or very good, the difference between 150,000 non-farm payrolls getting created or 100,000 non-farm payrolls?
Well, right now, that is definitely the statistic that everybody is looking at. But the truth of the matter goes to everything, right? It's about consumer spending. It's about what's going on. I mean, Europe is having some big struggles. You're looking at the DAX at highs with the IFO at 40, which doesn't make a lot of sense. But that's what you're seeing, is you're seeing a lot of things getting chased. And I think that if China can stimulate and get its economy going a little bit better, that's going to help. Globally, you need to see an economic uptrend. And whether or not that payrolls number, which we are all very focused on at the moment, because we think that it's very dependent on what the Fed's going to do, what that number comes out to be. But in the end, it really is about the totality of what's happening in the economy and not just those numbers. But a slowdown in the labor market would not be a great thing, because that tends to not be something that turns very quickly.
Nobody has an edge. And that's what really strikes me in this market. Nobody has an edge in understanding the macroeconomic backdrop in 2 months' time, let alone the political one, let alone a whole host of other potential unknowns. So do you lean into something that is what a lot of people say could potentially be thrown on its head if there is some sort of market deterioration that's visible in the market? Or do you get more cautious? Do you buy more gold? Do you lean into other potential hedges?
Well, I think that, the question is, what are you doing now? And you're keeping some of your big tech because they're generating a lot of cash, and there's no reason to say that this is a terrible place to be. But where you're looking is things where the valuation has some support, or you think that you're not too worried about the valuation. Because if you look at the market at a 22 multiple, you really need you really need things to continue to do well. You need those earnings to grow. So it's easier at this point to start looking in some of the smaller companies and trying to find ones where you see some growth, because you're less worried about the balance sheet aspect than you were. You still need a good balance sheet, but with rates coming down, it's less of an issue. And I think that you just need to be looking a little bit more broadly because you've had such a high concentration.
But Sarah, we've seen a lot of false starts with small and mid caps. So why now?
Well, this comes back to where's the economy going, right? And if the answer is the Fed is cutting rates and yes, you're going to see reasonably good economic stats over the next year, then that's going to be okay for small and mid cap. If we get into a recession or if the U.S. slows down, that's going to be very difficult, which is why they keep having these fits and starts, because every time we get a growth scare, which we had in the beginning of August and we had in the beginning of September, and people start worrying about the labor market creating a growth scare, then people back away from these names.
The former president's talking about a carrot and stick approach of bringing manufacturing to the United States. Could these false starts, start and stops, have to do with potentially how he's polling?
I think there's a combination of factors, but I also think, if we talk about the fact that we have collectively been speaking about how much electricity demand you need for AI and everything else. If you're going to pull manufacturing back, you also better have a great plan on what you're going to do with the energy infrastructure and the delivery of being able to say, sure, you can put a factory here, sure, you can put a data center here. And right now, you can't do that because you don't have the power to do it, literally. So I think that there are some ancillary issues that go around with some of those thought processes.
We're restarting nuclear plants to provide power to a tech company. Where is this heading?
That's one of those things where you have to look at nuclear if you're going to say we need all these things that we want about how we're going to deal with the energy infrastructure. There was a renaissance, and then that terrible issue in Fukushima sort of cut that off. But I think that what that's telling you is the demand is there enough that people are willing to do things that would have been unthinkable 10 years ago. And I think that that's, you look at what happened in Europe and how much of their nuclear capacity they've shut down, and you have to wonder, is that now something that they're rethinking? Because that's really creating problems.
So these were investment opportunities unthinkable a decade ago. Are you investing in this? And if so, how?
Well, so we like energy infrastructure, and one of the companies that I've mentioned before is Chart Industries. They make a lot of the equipment that goes into liquefied natural gas and other potential liquefying agents like hydrogen or other things like that. I think you have to look at that infrastructure. We went through a period where all of a sudden oil was nearly uninvestable and hydrocarbons were nearly uninvestable. And now people are coming back around to the fact that, wow, we really need a lot of power, and we need it from a lot of different sources, and we can't just rule out hydrocarbons that we like, the regular hydrocarbons. So you see a lot of areas where that investment is going to continue to take place, and that's something that we look at as well.
We're talking a lot about investment in the U.S. We're talking about the political sphere of the U.S. We're talking about U.S. stocks. How much do you have to stay in the United States at a time where all of these questions at least are, how much growth are we going to get? Not, are we going to enter some sort of severe recession? Or in the case of China, can we pull ourselves out of a deflationary spiral?
Well, I think so. For us, we're very U.S. focused in our investments. So for us, we stay looking in the U.S., but the U.S. is a really important part of the global economy, right? So to get back to that idea of like, where do you go now? You're looking for companies that are in good cash shape, that are able to return cash to shareholders, either by buying back their stock or dividends. We look at capital return very seriously, but the U.S. is really critical. If the U.S. is not doing well, the rest of the global economy is going to have a very difficult time doing well.
But is it U.S. exceptionalism on its own, or is it because it's being compared to places that are doing pretty poorly, especially in manufacturing, like Germany?
Well, I mean, all those terrible cliches about the worst dirty shirt and all that other stuff. I think that with the U.S., you really still have that innovation, and I think that that does drive, right? So the technological innovation that comes out of the U.S. really does drive. So however you want to characterize that, it does make a big difference, and it makes a huge difference in capital markets.
Sarah, it's good to see you. Always appreciate your time. Sarah Hunt there of Alpine Saxon Woods. We mentioned payrolls. Payrolls 2 Fridays away. The survey coming together, 7 estimates so far. The median estimate out of those 7, 140K is the estimate going into next Friday. 142, Lisa, the previous number.
To me, if it comes out like that, what do you do with it? I mean, that's basically the number that's going to leave nobody satisfied and determine nothing. So we get to do more of this.
The high estimate, 150. The low is about 100K. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Heckers. Hey, Yahara.
Hi, John. OpenAI has pitched the Biden administration on the need for massive data centers to power artificial intelligence development, as you were just talking about. The tech startup framed the proposal as necessary to compete with China, with each data center needing potentially as much power as what's needed for entire cities. Meanwhile, Kamala Harris and Donald Trump have no plans to debate again, but the candidates will participate in separate town halls hosted by Univision. The broadcaster said undecided Hispanic voters will ask the candidates questions, and the events will air with Spanish language translation. The Trump town hall will air on October 8th, while Harris will have her turn 2 days later on the 10th. And Sean Diddy Combs and Sam Bankman-Fried may be bunkmates. The Wall Street Journal is reporting the music mogul and the former crypto executive are being held at the same unit at the Metropolitan Detention Center in Brooklyn. Combs has been in jail since last week and was transferred to Bankman-Fried's unit on Monday. Combs is being held on sex trafficking charges, while Bankman-Fried is serving 25 years for fraud and conspiracy. That's your Bloomberg Brief. John.
Yahara, thank you. More from Yahara again in about 30 minutes' time. Up next on the programme, economic policy taking shape.
Under my plan, American workers will no longer be worried about losing your jobs to foreign nations. Instead, foreign nations will be worried about losing their jobs to America.
Tobin Marcus of Wolf Research up next, live from New York. Good morning. Coming into Wednesday, just off all-time highs on the S&P 500, negative by 0.02%. Under surveillance this morning, economic policy taking shape.
We're going to rebuild our manufacturing, and it's going to happen. It's going to happen fast. and beautifully. And under my plan, American workers will no longer be worried about losing your jobs to foreign nations. Instead, foreign nations will be worried about losing their jobs to America. Your only worry will be deciding which job to take.
Making job openings great again. The former president of the United States and Kamala Harris promoting their economic plans across several swing state events. Trump heading to North Carolina, Harris making her case in Pittsburgh later today. Joining us now is Tobin Marcus of Wolfe Research. Tobin, welcome back to the programme. I've got a couple of questions. Ultimately, it starts like this. When you go through the polls, they seem to trust the former president with the economy more than the sitting vice president. The gap has narrowed, but he still has a slight edge. When you look at the national polling, Harris has a bigger lead over Trump, even though we know the economy seems to be the most important issue to the electorate right now. So it leads me to this question. Do you think the national polling is still underestimating the former president?
I wouldn't bank on the national polling underestimating Trump. There's always a possibility of a polling error. Our priors are that polling error is symmetrically distributed. Historically, polling error in one cycle hasn't predicted polling error in the next cycle. And I think the numbers make sense. I mean, the economy is the single most important issue. It's far from the only issue. In 2022, in the midterms, we saw, at a period when inflation really was out of control at the time. And I think it was even more stood over a lot of issues for swing voters is kind of the single most important thing. Republicans had an advantage and were not able to convert that into the red wave that a lot of people expected. So, it's a landscape when a lot of people have a lot of reasons for voting these two different candidates. They have very, very starkly different agendas that they've been articulating. So we're taking the polling, for the most part, at face value.
But in your note, you talk about the suspense of a potential Democratic trifecta, and you say that would present the most unexpected risks for markets. What would be the riskiest parts of a blue sweep?
So, the reason why I think markets are probably, going to have a worse reaction to a blue sweep than the other scenarios that we're looking at in the immediate aftermath of the election is because, then you get the possibility of tax increases, in particular corporate rate hikes, that Harris has proposed. I mean, that's the key kind of consideration as we listen to these two candidates laying out their plans. Harris is very unlikely to have unified Democratic control to actually go ahead and do all the stuff that she's talking about. Trump is much more likely to have unified Republican control. And I think even more importantly, the things that he is talking about in more cases are things that he can do on his own, with tariffs being the big example. And to me, the big takeaway from his speech this week was just how much he is doubling, tripling, quadrupling down on tariffs. I don't know how anyone can listen to the agenda that he's laying out, the way he's laying it out, and think that it's just kind of cheap talk about tariffs. I mean, it really plays a central role in the way he's thinking about his economic strategy.
Tobin, in your note, you also outline a number of potential risks or surprises that we can expect over the course of the next few weeks before November 5th. Which one of those is most likely?
I think the thing that we've been getting the most incoming questions about this week is the possibility of this port strike on the East Coast that's coming up. Certainly, if we get sort of the worst version of that, where it's nationwide, it's protracted, it's totally unresolvable, that's something where you worry about, both the economic disruptions and what that would mean for the campaign, I think probably redounding to Trump's benefit. Our base case is that work stoppages are not as sweeping as I think feared, but that's an uncertain situation that we're taking day by day. So that's sort of the nearest one that we're watching.
Well, this would be in the East Coast. Which state could be most affected in terms of this impacting voters?
I think, all the kind of coastal states you have some concern about. I think sort of manufacturing across the upper Midwest that kind of depends on port access and then directly in Georgia and North Carolina. But really, I think it's less about kind of what it means for any particular voter in terms of the disruptions that they face, and more about the atmospherics of chaos, that sort of concerns about nationwide economic disruptions, the sense that sort of the labor movement is overreaching, that Biden and Harris aren't kind of strong enough to manage the situation. That I think would be the concern for them.
Tobin, I love that phrase, atmospherics of chaos, and I think that really is the name of this year. I am curious going forward, if you're looking at the potential for a House or a Congress that is for one party, a question of what one party can even do within itself. I mean, the Republicans cannot get together to come up with a provision to stave off the debt ceiling limit, and so you see Mike Johnson partnering with the Democrats. Is this basically what's going to happen regardless of who's at the top of the ticket?
So there's some things that will need to be done on a bipartisan basis, like keeping the government running, keeping the lights on. That's what they're struggling with this week. But I do think that if we get a Republican sweep, even though those margins are going to be very narrow, I think they're going to have to pass a big tax bill on a partisan basis next year to deal with this tax cliff. And so I think there will be a very, very, very strong incentive for Republicans in Congress to hold together on something. And the question is just what the contents of that package are. So, I'm not betting on Republican disarray to kind of completely stave off the threat of things like partial IRA rollback. I think investors have to take those risks seriously, even though we've seen obviously very fractious Republican contingent in Congress this year. With Trump in there, with very strong incentive for the team to kind of hold together and pass something, I do think we need to take that seriously.
We do get a speech later today from Kamala Harris. We've heard some of her proposals. Light on details. You say what you see is what you get, what you hear is what you get. What are you listening for today?
I think in terms of Harris, it really is more what the policies say about the candidate than what the candidate says about the policies. It really is not likely that she's going to have the chance to do the things that she's talking about. And so I think that the agenda she's laying out is mostly by way of letting voters know what she stands for. It'll be interesting to see what she says about industrial policy in particular. The previews of the speech indicate that she's going to talk about kind of targeted incentives, building on Biden's record in terms of the Inflation Reduction Act and the CHIPS Act of kind of trying to put targeted policies in place to bring strategic industries back to the states. So, I'll be watching what she's saying there with interest for the kind of medium-term future, how much both parties are kind of shifting towards industrial policy, but the likelihood that she can get any of that through in 2025 in the form that she's proposing it today, I think is quite low.
But Tobin, don't the policy speeches she gives now matter even more because of how many times she's flip-flopped in the course of the past few years?
Yeah, absolutely. And again, it's about giving voters a sense that they understand what she stands for, I think is the name of the game for her at this point. These are, she's trying to articulate a vision. She's trying to let swing voters have a sense of like, this is what she believes. These are the kinds of things she'll be trying to accomplish. These are the kinds of, people and industries that she's going to be fighting for. The actual content of a Harris presidency, will be a lot of bipartisan deals, will be a lot of case-by-case decisions about regulation. But given how dramatically her stances have changed on a range of issues from 2019 to today, I do think that she needs to give people a sense that they can trust the agenda she's running on now, that this is the real Kamala Harris, and that the things that she's promising to do now at least represent her North Star, her vision for the future, even if she's not going to have a chance to enact them in exactly the form she's laying out.
I guess we'll see. Tobin Marcus, thank you, of Wolf Research with the latest. I've got some data for you. Let's talk about it. Borrowing costs in the mortgage market, the lowest, the cheapest in 2 years. Check out this data. Applications to refinance mortgages absolutely surging for a second week. I'll share some of the data with you. The Mortgage Bankers Association's refinancing index jumping 20.3% in the week ending September 20th.
Well, yeah, if you borrowed money at 7.5%, wouldn't you refinance at 6.3% or something like that? I mean, you're going to see more and more of this. Really, the key issue for me is how much is this refinancing and how much is this new purchases? Because when you look at how long homes are sitting on listings, even though the number of homes is going up, they're sitting on listings for longer. So that's sort of the gap that people are looking to close.
People are excited to come back into the mortgage market. But when you say refinancing, I just think of my broker who continuously tells me, don't worry, apply, just refinance. You know the Fed's going to keep cutting.
The bulk of this is refinancing. To your point, what would it take to really unlock the inventory that's been locked up over the last few years?
Both the inventory and the true demand, and what would housing prices be? What's the clearing price? And that's something that I was reading actually a number of reports on yesterday, not for personal reasons, but I was just trying to understand. For just to understand. No, but in some places you're seeing housing prices tick down. Other places, on average, they continue to climb, as we saw from data yesterday. But this is really the key question. When you start to unlock that, which direction do things go? Because the all-in costs are, I hear, still pretty expensive.
We'll talk about this more in about 20 minutes' time. Nothing personal here whatsoever. Danielle Hale, chief economist over at Realtor.com, joining us at about 7:45 Eastern Time. Up next on this programme, we'll speak to Lisa Coleman of JP Morgan Asset Management on the headwinds to top-line revenue growth. The latest on the global credit market. Up next, equity futures just about unchanged from New York. You're watching Bloomberg TV. Equity futures on the S&P 500 pulling back just a touch. We're down by 0.03% after closing at another record in yesterday's session. On the Nasdaq 100, down 0.2%. Nvidia lifting all boats, seemingly, in the world of tech yesterday.
So I was looking as to why, and it's because there is a sense that maybe Jensen Huang is done selling his shares.
There's a report in Barron's.
Okay, so that's the reason why Nvidia single-handedly lifted the stock market. I mean, it really raises this question of how divorced this market is from some sort of broader macroeconomic story. We're talking about the difference between 100 or 150,000 jobs. Is that going to really make the difference between a bull market and a bear market? And then it just comes down to whether Jensen Huang is selling a stock still.
The equity market's not the economy. We've said that repeatedly. That's been true for a while. Away from that, if you stripped out that story yesterday and looked at the move off the back of consumer confidence, there was some worry about the state of the labour market in that conference read. And I think that just gets people a bit anxious going into payrolls in 2 weeks' time.
A feeling of what are we missing? A feeling of are we on this sort of deterioration? And one thing that I thought was notable was Andrew Hollenhorst of Citigroup coming out and saying a variety of indicators confirm that the labour market is at risk of entering a period of more rapid weakening, and the idea that consumers feel like the number of job openings or job availability relative to a lack thereof is really going down. You're not seeing that kind of optimism going back to levels we saw just at the edge of the reemergence from the pandemic in 2021.
Andrew believes that by the time you get to November 7th, we'll be talking about another 50 basis point interest rate cut over at the Federal Reserve. Let's turn to the bond market. Yields lower yesterday off the back of that data. They're higher again this morning. The 10-year's up 3 basis points. Bramo, the 10-year, 376.02.
This is sort of the two sides of the fighting story. This idea that the Fed could cut by another 50 basis points in November. And at the same time, you see sustained growth to support risk assets. And that war is playing itself out in the bond market with the steepening of the yield curve. This idea that you could see ongoing growth. Question of which signal to take, right? Can the Fed continue to cut at that kind of pace without some more weakness that could threaten a longer-term trajectory for both risk assets and, frankly, for the economy?
Hardest trade in the world right now, one of them, I think euro-dollar, 111.85, came really close to 112 overnight, 111.99, just short of reaching that level. I say it's really difficult because the data in Europe's bad. It's just really, really bad compared to still robust growth in the United States. And you see this from the OECD outlook again this morning, saying robust growth for the United States into 25, slower but better than what you're going to see out of places like Germany.
But maybe it has nothing to do with Germany. Maybe it has nothing to do with Europe. Maybe it just entirely has to do with the People's Bank of Japan and how much they're going to cut rates overnight. And that's the reason why you are correct. If you're trading euro dollar this morning, I really feel for you, because how do you get a handle on which narrative to follow? Is it the delta between the U.S. and Europe in growth or rates? Is it also just what's going on with respect to how much stimulus the PBOC can inject?
Speaking of China and the stimulus they've been injecting, dollar CNH, the offshore yuan, breaking 7 for the first time in about 16 months, a little bit earlier in the session, just north of that level at the moment. That currency pair now firmer by 0.2%. Let's get you some news. Under surveillance this morning, the Iranian president saying plans are underway to discuss a nuclear deal that's been stalled for years, but didn't provide details on the timing and location of discussions. The Iranian leader telling Bloomberg the deal was among topics raised with French President Emmanuel Macron on the sidelines of the UN General Assembly.
So I guess Masoud Pezeshkian, the new Iranian president, is feeling pretty positive, he said, coming out of this meeting. But I'm sorry, what Iran says and what Iran does is completely different. What are they doing? They're supporting a terrorist regime, as what the United States designates when it comes to Hamas, when it comes to Hezbollah. We have overnight the Trump campaign coming out and talking about a, quote, significant threat the Biden administration has told Trump on his life based off the Iranians. But then you have the Iranian leader come to the United Nations in New York City and say, nuclear talks, anyone?
Honestly, this is to me the issue when you have a situation where Iran is speaking out of both sides of their mouths, right? They're talking about potentially accelerating some of their involvement in the conflicts that are ongoing, saying that Israel can't get away with this. And on the flip side, you have sort of a make-peace kind of feeling. This, to me, is why traffic is so bad in the United States right now in New York City.
Good
because
Let's go.
You have Iran, you've got the president of Iran.
It's Macron's fault too.
Yes,
there's always
he's
Macron
here.
playing statesman
Macron's
somewhere,
here.
right? Always,
you've got Joe Biden. You've got maybe
dining
Trump
on the Upper East Side.
I'm
you
really
have
on board with this.
You have, hold on a second. You have the Prime Minister of Israel that's going to join this fray on Thursday, supposedly.
His fault too.
Well, You have the Turkish president. You have pretty much everybody under the sun who all hate each other coming here and getting in a room. And so traffic is basically completely stalled.
Someone got stuck in traffic yesterday. It's basically the conclusion
personal.
of that rant, right? That felt very personal.
I mean, can you imagine? All sort of consolidated in less than a square mile.
It's always Macron's fault somewhere, right?
You can blame him.
Playing statesman. Volkswagen and its unions starting negotiations over wide-ranging cost cuts. The talk centering on the automaker's plan to potentially close German factories for the first time after scrapping decades-old job protections earlier this month. This one's going to be a battle, a real fight over in Germany.
Oh, absolutely. And this is going to become very, very political because you cannot lose jobs in the German manufacturing base. This was the darling of Europe when it comes to the auto manufacturing in Europe. The union's already talking about there will be no cuts. How does VW and all these other companies start potentially turn a profit? And guess where they're laying the blame? At the politicians, because the destination and the goal of getting there do not match.
VW right now down 0.5%. I want to turn to this story. Just an update. Univision announcing 2 separate town halls next month with Donald Trump and Kamala Harris, both in front of a Spanish-speaking audience. The candidates getting the opportunity to speak to one of the largest voting blocs in this country.
36 million Hispanics. That is the voting bloc of those individuals in the United States. This is an opportunity, a town hall. I really want to see if we get details of these policy ideas. They're all talking about spaghetti at the wall, the Oprah Winfrey election. What are the details and actually how you would accomplish these things?
I find it interesting. The Hispanic vote in this country used to go for the Democrats, and it's changing. And I find that kind of really interesting. I also find it interesting we're talking about town halls, not debates. We're not talking about personal interviews.
36% went for Trump in 2020. So, this is a vote that you cannot ignore.
Minority groups in this country haven't been happy about the liberal immigration policies either. I think you've seen examples of that repeatedly.
And you do see that, especially in the Hispanic community. Many of them will say, and I've spoken to some of these individuals, I came here legally. It took me a ton of money, legal fees, a ton of time. It was a huge burden on my family. And actually, they are very annoyed with the levels of illegal immigration into this country.
Want to watch in the next month or so? Let's talk about this market. US companies looking to protect the top and bottom line as the Fed kicks off its easing cycle. Lisa Coleman of JP Morgan Asset Management writing, companies have been working hard to maintain margins by maximizing efficiencies wherever possible, except for tech. Layoffs have not been and are not anticipated near term. Lisa joins us for more. Lisa, good morning. It's good to see you, as always.
Nice to see you, too.
Before we talk about margins, let's talk about top-line revenue growth. Why do you think that's going to be so challenged in the year to come?
Yeah, it's been declining steadily. When we look back over the trough in EBITDA, so, going back, let's say, about a year, that started to recover, and it's really moving very nicely up. But revenue at the top line has just been slowing and slowing. I think that's consistent with a slower economy. But I think what's really fascinating about this is companies, I give this analogy, companies are like a duck on the lake, right? They see this top line that's kind of waning a bit, and they're really trying to maintain margins, and they're paddling faster and faster and faster, and they're doing a really good job of maintaining margins. When you look at the median company within our investment grade universe, they've been able to maintain margins at around 14% on an operating margin basis. That's pretty good. So, really what we're waiting for now is, can we start to see a kickstart to the top line? And I think this probably goes back to what the Fed's going to do with the economy.
So what I'd be worried about, and this is me, I'm a worrier, I've got Lisa for company. What I'd be worried about is that the next step is that they run out of their ability to maximize efficiencies and protect margins, and the next step is layoffs. Do you think we're easing early enough to say really the next step's top line revenue growth, the margins are going to be okay?
Right. Well, it's interesting you make this point, because when we went through, we looked sector by sector. And as you mentioned in your lead-in, it's really just tech that has been the one area that's been laying off. Now, tech has been using layoffs as a way to maintain margins for probably the better part of 2 years. So this is not a new phenomenon with tech. But you're right, other sectors really have not. And, we can look at how they've maintained margins. So you look at energy companies, there's technological change. Companies have been very good about making acquisitions where they had more contiguous acreage. So there's no need to make layoffs there. Even the spot of consumer goods, for example, companies built in a lot of resiliency in light of the supply chain problems that we had earlier. But maybe they don't need that anymore. So, we've had the efficiencies come through. But I think you're right. If we don't start to see an improvement in the top line, can employment start to be the lever that they pull? So far, I think there's been a reluctance, and maybe it's a little PTSD after what happened during COVID with finding people, training people, and the like. But I think it's something that we're a little bit on a precipice here.
I love the granularity that you have when you look under the hood. And I want to go a little further, talk about the nature of how these companies look at employment, because it speaks to the uncertainty that we see in the data. How much are companies not making broad-based layoffs, but not hiring either, and kind of relying on attrition and expecting to end up with a smaller footprint relative to the size of their businesses? And I'm thinking of U.S. banks, where CEOs have even come out and said that that's going to be the future. I mean, is that kind of what you're seeing in terms of this paddling duck type of corporate sphere that we're looking at?
So far, not yet. I think if I were to get down to that level of granularity, I think we'd see that there is not necessarily new hiring. And so you know how the drill goes. You take away the job openings that might be posted. Maybe you pull back there. So you're not actually removing workers from your company. But I don't know. I think as we maybe go further down the road, if we don't see the economy start to pick up, as John was saying earlier, I think we are going to see maybe some deeper layoffs. But again, nothing to indicate that at this point. Everything, it's like the calm waters on the top, the duck just paddling along.
So moving from 1,000 feet to 5,000 feet, there's a question about the U.S. We're talking about companies here and their ability to withstand and maintain that 14% margin. How different are things right now in Europe, in particular in Germany, in the sphere that you're looking at?
Yeah, very, very different. So we did a little comparison across Europe. We looked across sectors and said, who's doing well in Europe and who's not doing well? And what we found is companies with exposure to China were doing much worse than those companies that didn't have that exposure. So just to throw a few numbers on it, if you look at EBITDA growth through the end of the year that we're projecting, for Europe in general, we're thinking around 3%. If you're looking at companies with exposure to China, we're seeing those companies down 5%. So it is a vast difference. Now, granted, some of that is influenced by auto manufacturers. And auto is not just about China. There are other issues. But yet, you see it in companies with retail exposure, with consumer products. They're all starting to see or feeling that downturn and that lack of growth that's coming through in China. And I think that is the big difference between U.S. companies and many companies in Europe, is that China representation.
Lisa, do you think that's an opportunity, given the easing we've started to see from Chinese authorities in the past 24 hours?
Yeah, I think it's too early to know. I really do. We're just at the very early stages. I mean, autos are a different one, a different kettle of fish here, because the China story is much more complex for autos. What a lot of people may not realize is when you start to look through the surface at auto manufacturers, particularly European ones, where they're making their most money in China is not on EVs, but on ICE vehicles. And ICE vehicles are considered to be premium vehicles in China. Now, if you start to get tariffs put on Chinese EVs by the European authorities, do you get retaliation on ICE vehicles in China? So there you have, a little bit of a nuanced situation. And of course, as you alluded to earlier, for some of the auto manufacturers, there are very aggressive targets for emissions coming through. And that's really forced a lot of these companies into making very large capital investments, particularly at a time now we're seeing with EV demand starting to wane.
How investable are auto credit right now in Europe?
I think when we talk to the ratings agencies, what we're told is they will have some time. There is not an imminent downgrade expected for these companies. And when you look back, think about during the COVID period, these companies made a lot of money. And so they have really a little bit of money in the bank, let's put it that way. When we look at leverage, it's very low. Margins are still pretty good, but they're coming down. So again, the health is not bad. The ratings agencies don't appear to be primed, at least at this point, for downgrades. But I think you're subject to headline risk. And that is likely to continue for the next month, 2 months. But I think at that point, you may have an opportunity once we see spreads really compensate you for some of that headline volatility to get back into the space.
When you think of volatility, you have to think of the U.S. election. How much do you see these companies basically waiting on the sidelines so they have a little bit more clarity?
Yeah, I wouldn't blame them for waiting on the headlines. I mean, yesterday there was a good headline on Deere that we're all aware of. And I think what this speaks to is really, I think companies want certainty, particularly if you're looking at making large capital investments. And so until the elections have been decided, and also the composition of Congress is decided, I would suspect that many companies would probably take a wait-and-see approach.
The auto sector is in such a tight spot right now. The remedies that are required in Europe to cut capacity, to cut jobs, there's going to be massive opposition to them from unions and from government officials, particularly in Germany. And to Lisa's point, the outlook for tariffs, you've got no idea what the next 12, 18 months is going to look like for some of these companies.
Yeah, I love her point about the difference in the cars that get purchased in China. I was speaking to a car manufacturer from Germany, and they said that they're designed differently in China because normally it's the driver's seat that's really nice and that has enough space, and that the cars that they sell to China, it's actually the passenger seat because there's always a driver.
Live to be driven.
Yes.
Not to drive.
Is that your goal?
Basically. That's what Rolls Royces are for, right?
I guess so. I wouldn't know.
To be driven in, not to drive.
Robo-taxis.
Lisa, thank you. It's good to see you.
Thank you very
Appreciate
much.
it. Lisa Coleman there of JP Morgan Asset Management. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. Japanese banking giant Nomura is facing a fine of over $150,000 for allegedly manipulating Japan's bond futures market. A Nomura employee is suspected of fraudulently moving government bond futures back in 2021, placing large orders without intending to buy or sell them. The relatively small fine is seen as a threat to the investment bank's reputation at a time where it's refocusing on Japan as a key growth area for its business. Meanwhile, UK Prime Minister Keir Starmer wants to meet Vice President Kamala Harris and former President Donald Trump before the election. The Prime Minister has said Britain will work with whoever wins, but his governing Labour Party has connections to Democrats. Starmer is in New York for the UN General Assembly this week. And in sports, the Houston Astros clinched their fourth straight American League West title in a come-from-behind win, while the Baltimore Orioles secured their second straight playoff spot, and the Kansas City Royals held on to the second AL wildcard spot. That coming as the Mets and Braves battle for a spot in the National League wildcard, with Atlanta taking Game 1 of the pivotal series that could face weather delays with Tropical Storm Helene expected to hit northern Georgia today. That's your Bloomberg Brief. John?
Yahara, thank you. Are we all Baltimore fans now?
No.
Is that like company policy?
Absolutely not.
To get behind the Orioles?
If it is, I haven't gotten that cue, and this family is in the Mets
They
position.
won last night, so congratulations, David Rubenstein, if you're watching. But Aaron Judge, 56th home run last night. It was incredible.
There we go. We can see who supports who here. Up next on the programme, the Fed's hand in housing.
I think the Fed's going to pay attention to inflation, but probably what they're looking at more than any campaign promises is really what's happening with real estate, because that's the sort of the last piece of taming inflation.
Danielle Hale of Realtor.com. Up next on the programme from New York, this is Bloomberg. Down 0.1% on the S&P 500, just a little bit softer this Wednesday morning, up 3 basis points on a 10-year, your yield 376. Under surveillance this morning, the Fed's hand in housing.
I think the Fed's going to pay attention to inflation, but probably what they're looking at more than any campaign promises is really what's happening with real estate, because that's the sort of the last piece of taming inflation. And the problem in real estate is that you've had not enough housing for over a decade.
So here's the latest this morning. Applications to refinance home loans surging for a second week. According to the Mortgage Bankers Association, homeowners are looking to take advantage of lower rates. A 30-year fixed mortgage sitting at just over 6.1%. Danielle Hale of Realtor.com saying this. Surveys show that consumers expect additional mortgage rate declines in the next year, now that the Fed's long-awaited cut has arrived. However, the improvements may be more modest than we've seen to date. Danielle joined us for more. Danielle, welcome to the programme. So we've seen refis explode, surge over the last few weeks. How low do you think that rate needs to go before we start to see home purchases actually start to accelerate in a more material way?
Yeah, thanks for having me. So we've started to see a bit of a week-to-week uptick in the purchase applications, but it takes time for buyers to become aware. And remember, the mortgage application is a later stage in the home buying process. You have to have an offer on a home that has been accepted before you go to apply for a mortgage. So what we will actually likely see is that pending home sales start to pick up and then mortgage applications follow. The pending data is a monthly series. The mortgage applications are obviously weekly, so timing-wise, we might see the result in the mortgage applications first. But there's an order of operations here. So offer is accepted, and the buyer applies for a mortgage, and that's when we see it reflected in this MBA data.
Danielle, what do you make of the fact that actual listings have increased? It seems like there is some motion in the pool of existing homes that are actually finally up for sale.
Yeah, we've seen the number of homes on the market for sale growing very slowly over the year, but we're now up about 36% compared to last year. So it is a substantial improvement. Big picture context, we're still down pretty substantially from the 2017 to 2019 period, which suggests to me that there's more room for recovery in the market. And, as we see more sellers come into the market, we'll see that room improve. And I think it's important to note that existing home sellers are often also buying another home. So when we see existing home listings increase, we're really increasing both supply and demand in the housing market, which will help increase the turnover rate in home sales that has been rather sluggish in recent months.
I've seen a number of reports, Danielle, that show that homes haven't moved as quickly as some people had expected. So even though there are more listings, it's not as though they're flying off the shelves, and understanding that mortgage rates are still relatively high to where they used to be. How much do you view this as a sign of what's to come? That essentially, as you defreeze this market, you won't necessarily see the same kind of price increases as some people are calling for on the heels of lower mortgage rates?
Yeah, I think with affordability as stretched as it is in the housing market, there's less room for prices to run. That said, everyone, I think, has been surprised at how resilient prices have been in the face of higher mortgage rates. So buyers have been willing to stretch affordability as opposed to necessarily waiting for home prices to fall. And the big picture inventory shortage that we see is a big explanation for that. So if we look over the last decade, we are several million homes short of the number of households that have been added. And when you have that kind of scarcity in the market, it's hard to see prices really relax or decline in any meaningful sort of way. So I do think as mortgage rates improve, we are going to see buyers come back to the market. If we look at the time it takes to sell a home, we are seeing homes take longer to sell than 1 year ago. But again, if you compare to that pre-pandemic benchmark, we're still seeing homes sell about a week faster. And so I think we have some more room for the time on market to slow. At the same time, technology has improved, and it's much easier for, I think, shoppers to find a match in a home now than it was 4 or 5 years ago before the pandemic. And so we may see some of those, that market speed kind of stay as a factor in the housing market. And so buyers may have to make quicker decisions. But I think there are two things going on. There's the market momentum, and then there's the seasonal momentum that we see. And fall tends to be a slower period for the housing market. We see buyer demand wane. It's one of the reasons that we identify next week actually as the best time to buy, because buyers have some seasonal advantages with fewer of them and a good number of sellers still in the market. They have more negotiating power and often tend to see lower home prices than we do at the peak of the summer. So for buyers who are flexible and are not trying to sell a home as well, it can be a really good opportunity to get into the housing market. And the fact that rates are coming down now is just an added bonus.
We've got a flexible buyer sitting around the table, so we appreciate that particular advice. Danielle, thank you. Danielle Hale there of Realtor.com. Looking for rates to go a whole lot lower from here.
Well, if we only just had Lisa's 3%, wouldn't we all be, knocking on the door?
Be retired.
Are you trying to push me out? Okay.
No, I'd be retired.
This is an announcement.
I'd come in. I told you, I promised you 60 minutes a day.
60 minutes?
60 minutes.
And then you go tend to the goats?
I think I'd come in for the 8 o'clock hour. Then I'd tend to the goats.
Okay.
Why am I tending to goats? What am I doing?
No, you have...
A goat farmer?
You have lemon groves and you have cows for your ice cream.
OK, that sounds perfect. I'm not sure where the goats come in. Up next on the programme, Marianne Bartels of Sanctuary Wealth, Scott Ciccarelli of Truist, Laura Rame of FS Investments, and Victoria Fernandez of Crossmark. The third hour of Bloomberg Surveillance is up next.
there is a lot to like. I mean, this basically all comes down to the resiliency of the economy.
We expect the U.S. economy to continue to expand, to continue to grow with solid momentum.
Eventually, we do think that an economic contraction plays out.
Overall, the economy is performing like it doesn't really get impacted by kind of these swings in rates.
I think the bond market rally and the equity market need to happen in tandem, and they need to make sense rationally for what's going on in the economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Snoozy morning so far this morning, and we'll take that 90 minutes out from the opening bout. Equity futures just about unchanged on the S&P 500, down about 0.1% on the Nasdaq 100. Some relative outperformance on the Russell there, up 0.1%. Some muted price action, Lisa, in the last few hours.
Yeah, maybe it's because everyone's at home, because nobody wants to go through the traffic in Midtown Manhattan for the UNGA week. Is that what people call it? UNGA? Look, this to me, why would anyone make a major trade ahead of earnings? And actually, we haven't even talked about earnings, but I think earnings could potentially be one of the biggest catalysts going forward, as well as, of course, that non-farm payrolls, which evidently the difference between 100,000 and 150,000 is going to mean the difference between a bear market and a bull market.
And what we've been hearing, at least from the consumers on the survey board, I keep going back to this metric. Those that say the jobs are plentiful, declining. Those that say actually it's hard to get a job, that's rising. This is challenging, but it's leaning into this idea of traders who think potentially we're going to have to go 50. And then you hear from the Fed Governor Bowman yesterday saying that she actually wants to see a moderated path. Very different than, say, Goolsbee, who's talking about we're going to need some significant cuts.
Just to pick up on what you said, that differential in consumer confidence about plentiful jobs and jobs hard to get, when that starts to narrow, economists get concerned. That's been narrowing now for a number of months. That speaks to some weakness or some weakening in this labour market.
It was the weakest read going back to March of 2021. But the reason why I asked such a narrow question to Lisa Coleman last hour, I'm justifying narrow questions on a snoozy morning, but let me just explain that to me, there is this sort of feeling there have been structural changes in the labour market, the way that companies view labour post-pandemic, that mean that there's just more stasis. There isn't as much hiring, but there also isn't as much firing. Is that a healthy, good labour market? And that, I think, is going to be something a lot of economists are going to be thinking about.
You can only push it so far. So to pick up on Lisa Coleman's point, she joined us in about the last hour or so, about 20 minutes ago, and made the point that top-line growth is threatened. For obvious reasons, inflation's come down, GDP is decelerated, nominal GDP is lower. Got all that. When that happens, you start to protect margins. What do you do? Maximise efficiencies. The last thing you want to do is start layoffs, given that they were so difficult to hire after the pandemic. So now what you're hoping for is a re-acceleration in growth off the back of interest rate cuts so that we don't go through this layoff cycle. And that's really the difference between being bullish and bearish right now. What you think or don't think is going to happen to the labour market in the next 12 months.
Which is the reason why some of these incremental data points are going to be so important and potential catalysts for some volatility. If we get 140,000, which is the median, that settles nothing, because ultimately you'll have people arguing both sides of the discussion, as we have been for the past 6 months.
Got jobless claims before we get payrolls. Payrolls 2 Fridays away. Jobless claims tomorrow morning at 8:30 Eastern time. The estimate in our survey, 224. The previous week, 219. The price action looks like this. Equities pulling back by not even 0.1% on the S&P 500. The move in yields will resume the climb. We're up by 3 or 4 basis points on a 10-year, Lisa, 376.40.
What's fascinating is the steady grind higher in 10-year yields since the 50 basis point move by the Federal Reserve. Early days, hard to make so much about this, but we've talked about reigniting of inflation concerns. We've talked about this question about whether bonds will act as the ballast or the source of risk during a sell-off period. And that, I think, is going to be an increasing question as people consider whether preemptive rate cuts will actually keep growth and inflation higher.
Gold, record highs.
I know.
You've got company.
I do.
A lot more people coming on the show in the last week making the same point.
Yeah, but someone's going to look down the barrel and say, gold, really, Lisa? And, they could be right.
Mark Zandi and Moody's.
And they could be right. Maybe this is just a peripheral kind of reading, but that has strengthened for consecutive days to record highs in tandem with higher yields, in tandem with some other concerns percolating on the edges that maybe we will get some sustainable inflation.
Another record high on gold this morning, up 0.1%. Coming up this hour, we'll speak to Marianne Bartels of Sanctuary Wealth as the S&P 500 hits a new record high. Scott Ciccarelli of Truist on why he's snapping up Walmart shares and leaving Costco on the shelf. And Victoria Fernandez of Crossmark on why the path of least resistance for stocks is higher. We begin this hour with stocks coming off their 41st record high close of the year so far, propped up by Nvidia and tech as traders shrug off much weaker than expected consumer confidence numbers. Marianne Bartels of Sanctuary Wealth seeing more room to run, saying our bullish view on stocks just got even more bullish thanks to the Fed's 50 basis point rate cut. The Fed is also planning future cuts, and this is extremely bullish for stocks. This gives me confidence that the S&P 500 has the ability to reach 6,000 before the end of the year. Marianne joins us now for more. Marianne, welcome to the programme. When I read things like extremely bullish, I'm not thinking about 5% upside. I'm thinking about 10, 15 and 20. How much more upside is in this equity market?
Well, I can still get the equity market up to 7,000. That's my highest target, not for this year. I do think we can get to 6,000 this year. So I can still get the market up 7,000. I think these rate cuts that are going to come down the pike are really going to continue to fuel this bull market going into next year.
Okay, so what's this going to be driven by? Ongoing small caps and the equal weight, or is this going to be participation all around because it's soft landing nirvana?
Well, you do have a broadening of the market. Like if you look at industrials, that's one sector that's on the cyclical side is really liking the rate cuts, also liking the stimulus from China. We have not seen tech as the leader since the correction, but my sense is that they will resume their leadership within this market. And semiconductors being the key leader, I call them the leaders of the pack. So I haven't given up on the leadership of tech because historically, if you lose your leadership, you lose your market. I'm not looking for small caps to, it's like when the tide rises, all boats lift. Small cap can certainly go up, but I don't see it as leadership within this market.
There's a real question that we've been analyzing this morning about inflation and whether we're starting to see the seeds of maybe some fear creeping back into markets with higher yields in the long end. Do you believe that this is actually a reflection of potential reinflation types of scenarios down the pike, particularly what's happening in gold and yields? Or do you see this as just something of a head fake?
No, we've been in the camp that we are in a secular trend now for inflation, that in 2000 and 2001 were the secular lows for interest rates, and that interest rates are on a 20 to 30 year cycle of rising. I do believe sometime in the future we will see 10% interest rates. So I do think the back end of the curve is concerned about growth and inflation. Gold, I definitely believe, is picking up that we're now in a inflationary environment, but the cycle right now is for inflation to go down. So the long-term inflation is up, short-term the inflation cycle is down. And what I've been telling people is I do think rates at the short end of the curve can drop pretty dramatically. I think we can get the 2-year at some point down around 2%, 1.5%. I do think over time the 10-year will go down. But what I think is key here is if anybody needs a mortgage, anybody needs to refinance, anybody needs a loan, when rates drop, this is going to be your last opportunity to lock and load.
I'm just trying to square this idea that you could see the 2-year going down to a 1 handle or 2%, but also seeing the seeds of a soft landing and potentially 7,000 on the S&P 500. Don't low rates like that imply some sort of accommodation akin to a weak backdrop?
You would think so, and I would think that to be the case, but not if the Fed cuts aggressively and hints that they'll cut aggressively, because the market will move for them. It could be that the first half of the year is good and we see a pickup in growth in the first half, and then we see weakening in the back end. But I think this has more to do with the Fed having an easy policy than a significant slowdown in growth.
In June, you wrote a lot about the utilities and real estate and how you wanted to get in on those trades. Is it too late to buy into those sectors?
No, I think TINA's going to come back. I think sometime next year we're going to be talking about TINA, especially if rates go to the levels that I think we're going to go to. The market has been hunting and pecking for yield actually back since June. We actually got strong buy signals on utilities and REITs back in June. And I still think the market will, or investors will seek out yield within this market as yields go down.
Marianne. bulled up. It's going to catch up. Marianne Bartel's there of Sanctuary Wealth on this equity market. TILA's making a comeback next year. What do you make of that?
I make it, this is a Fed that's got the markets back, and that is the white hope, the white knight hope out there that essentially you're going to get rate cuts in advance of weakness that will stave off that weakness. And that is what this market is leveraged to, which is the reason why yesterday we saw that 50 basis point rate cut in November being priced in on the heels of a subset of the Conference Board data. So a lot of this kind of goes to the feeling that people are hoping for a lot of heavy lifting from the Federal Reserve.
Stuart Kaiser of Citi yesterday. If the economic data begins to justify larger rate cuts from the Federal Reserve, it gets harder, not easier, to be bullish because that data is getting weaker, and that's a problem.
The big, I guess, sort of fly in the ointment here is this question of just how willing is this Fed to get ahead of any weakness? Is Austin Goolsbee the mainstream of this Fed, saying that they're hundreds of basis points away from neutral and they've got a lot to cut just to even be okay, not necessarily even accommodative? That's not clear. And I think that if the rest of the Fed agrees with him, then frankly, the bull case that for cuts, even without that weakness.
Super strong.
Super strong.
Couldn't agree more. If Goolsbee's the Fed chair, limit long.
Yeah.
200 basis points north of neutral. Let's get there super, super fast. We think we're super restrictive. We don't need to cut 200 basis points. We don't need weak data to do that. It's basically what he's saying, right?
Well, and if you get that kind of scenario, then essentially you've got a Fed that is greasing the wheels for a recovery before we get a downturn. And that, I think, is what a lot of people are basically levering up to.
Lots more Fed speak through the week. Let's get you an update on stories elsewhere. With your Bloomberg brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. China conducted a rare missile launch into the Pacific Ocean in what appears to be the first such test in 4 decades. The nation's military confirmed an ICBM was launched with a dummy warhead and fell into the expected area without offering further details. China said it notified relevant countries in advance of the launch, but an official from the Japanese government said his nation received no such notice. The National Hurricane Center issued watches and warnings across Florida as Tropical Storm Helene continues to strengthen. According to the latest advisory, the storm is expected to be a major hurricane by the time it makes landfall Thursday night along the northeast coast of the Gulf of Mexico. And the man who was found hiding in the bushes with a loaded rifle at Donald Trump's golf course in Florida has been indicted for attempting to assassinate the former president. According to an indictment released yesterday by the Department of Justice, Ryan Ruth was charged with attempted assassination of a major presidential candidate, possessing a firearm to attempt to commit a violent crime, and assaulting a federal officer. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the programme, some Morning Calls Plus. Scott Ciccarelli of Truist on why he's bullish on Walmart, but pulling back on Costco. That's next. This is Bloomberg. Equities right now pulling back by 0.06% on the S&P 500. Bond yields higher by 4 basis points. The 10-year 376.97 got close to 380 yesterday, breached that level, pulled back again after consumer confidence came in weaker than expected. The next big data point for this market, jobless claims tomorrow morning, 8:30 Eastern Time. Let's get you some morning calls. First up, TD Cowen downgrading Expedia to hold from buy. The analyst saying its consumer business may take longer than expected to turn around. Your second call from Morgan Stanley, cutting General Motors to underweight. The analyst forecasting increased market share loss through the end of the decade. GM down by 3.4%. And finally, Barclays upgrading HPE to overweight from equal weight. The analyst citing signs of a recovery in enterprise service. That stock still lower by 3.4%. Let's turn to retail. Scott Ciccarelli of Truist upgrading Walmart to buy, citing its increased market share across all income levels. However, he's downgrading Costco to hold due to changes the retailer has made to its shopping experience. Scott joins us now for more. Scott, welcome to the program. Let's start with Walmart. What are they doing? How are they executing that gives you a little bit more confidence in the name?
Well, I would tell you that, they've always been a low cost leader. OK, and so they've had that kind of reputation with consumers. But I think the big change with Walmart has really been continuing to roll out various convenience options, and whether that's home delivery, curbside pickup, they had this membership program, basically Walmart Plus, and then all sorts of derivatives off of that. So any kind of resistance you have had to shopping at Walmart, they've kind of knocked them down. And against other convenience-based retailers, they've really been able to narrow that competitive gap by really being able to service customers no matter how you want to shop.
So Costco, as you know, is not just a relative trade. Changes the retailer has made to its shopping experience. What is it about the shopping experience of Costco right now that you think is harming consumption at the stores?
Yeah, so to be, completely, for full disclosure here, it's partly a valuation call. I mean, the stock has added $160 billion to its market cap in the last 12 months without any real change in their growth trajectory. But on top of that, to the point you just made, they have made some changes. As an example, they're rolling out scanning people's membership cards on entry rather than people just walking in and just showing their membership card. And we think at the margin that could have a negative impact on the company. When somebody who comes in and that there's what's called friend groups, kind of sharing a membership, maybe there's 4 people and, the one person, has the membership ID. Maybe one other person signs up, so you could have an acceleration in membership signups. But maybe 1 or 2 of those people that were buying stuff before, they're going to stop buying. And so, again, there could be a negative ramification for a stock where I just don't think there's a whole lot of room for error at this stage. The other thing that if you go through some of the various forums, people are talking about their rotisserie chicken. It's an iconic product from Costco. It's still $4.99 after, all these years. And yet they've changed the packaging and people are complaining that the product's a little more soggy, that the bags leak, et cetera. And so, again, it's not necessarily a game changer. But again, for a stock that has very little room for error, it's changes at the margin that not everyone's going to love necessarily.
Before we move on to Walmart and just sort of compare and contrast, just to develop that a little bit, how much business do you think they're going to lose as a result of password sharing crackdown, which is essentially what they're doing, or card sharing crackdowns?
It's really hard to tell. I don't think they actually have a great idea of how many non-members are shopping there. I mean, the anecdotes would suggest that people certainly are not members and do shop there. So again, what I'd be concerned about as an investor at these valuation levels is any kind of moderation in the sales levels. That could wind up being a negative catalyst for the stock when you've had that much appreciation in such a short period of time.
There's a problem, I guess, if that is the narrowing kind of gap between potentially a beat or a miss when it comes to earnings revenues, which is the reason why every company, retail, airlines, et cetera, wants to become a credit card company, wants to also become a shipping company, also wants to become something having to do with media and tech. How much is that what distinguishes Walmart from the likes of Cisco, that they can be an advertising company too? They can also be an ad-driven kind of sales machine.
Yeah, well, when we're talking about Walmart, I mean, I think they kind of saw the model that Amazon created, right? And so Amazon, whether it was AWS, their advertising business, the logistics business, they all become higher margin revenue streams that can help subsidize the core retailing business. And I think Walmart's basically taking a page out of that book. Because if you look at what Walmart's doing and the some of the numbers that they've given us, some of it's opaque to be fair, but some of the numbers that they've given us, it is much higher margin than their core retailing business. You could make an argument their core retailing business is operating down at like a 3% operating margin, several hundred basis points below what it used to be. And a big chunk of their profits now are, probably 30, 40% of the profits are now coming from these ancillary revenue streams. And again, what you can do with that is drive margins higher, so good for investors, but also help subsidize that retail business, drive prices lower to open your price gaps against competitors, which again helps reinforce that flywheel, which they can utilize to continue to gain market share.
Scott, what was it about Walmart, the catalyst, that really now means that they are this destination across the entire income cohort?
I think it's probably the convenience options. Again, they've always had kind of that low price focus. They probably, let's call it, got religion on, kind of really driving wider price gaps probably 6-7 years ago. But it's the convenience options that I think just breaks down those barriers. And again, whether it's the home delivery as they build out their Walmart.com business, the curbside pickup, they've rolled out the Walmart Plus membership, very similar to what Prime has done or Amazon's done with Prime. And so, again, they've just increased that convenience factor so dramatically that, people that may not have shopped at Walmart before can now shop at Walmart, and they feel good about it because they can get good prices and they can have home delivery if that's what they want.
They appear to be taking share from the dollar stores as well. It's not just trade down, Scott. I want to talk about some of the dollar stores with you. You wrote this about Dollar Tree in the last few weeks. Investors expected a mess, and that's what they got. But you still like this stock. Can you walk me through why you'd still buy this name this morning?
Basically valuation. I think the stock has been taken down to the point where it just isn't super logical in terms of where investors are treating it. But have they lost share? The answer is yes. They purchased a company called Family Dollar, probably almost 10 years ago at this stage, and they haven't been able to turn it around. They had they had activist investors come in. They brought in new management. In fact, management that was very successful at turning around Dollar General back in 08, 9, 10. And they just haven't been able to pull it off. And at the same time, you've had Dollar Tree, where they've changed pricing. They've tried to implement, higher price points within the stores. And, it's been with mixed results. But Dollar Tree ultimately is a pretty good business. It's differentiated enough from a Dollar General, from a Family Dollar, from a Walmart or Target that I think it should deserve a better valuation than I think what's being afforded in the market. So honestly, it's been a poor call on our part and, some other investors as well. But, it just doesn't make logical sense to downgrade the stock where it is today, in our opinion.
Scott, I just want your thoughts on something that's really bugged us over the last few months or so. When we hear from these companies, it just sounds like the low-income shopper is on his back, is really struggling, things are terrible. We never hear the CEOs talk about poor execution. How much of it is just about the low-income shopper struggling, and how much of it just about poor execution at the management level at some of these stores?
It's pretty hard to, kind of divide the two. The low-income consumer started to really turn negative in 22. It got worse in 23, and you can make an argument it's worse again in 24. So there's a compounding effect that, I think has, had ramifications across the spectrum of any company that really has any kind of exposure to that low-income consumer. But in terms of execution, there have been missteps. And I would tell you that a lot of companies are still struggling with the aftermath of what happened with COVID. You had, shutdowns, and then you had this massive surge of demand. Well, what else happened? You had people job hopping. The job market, was super flush. And so people could walk across the street and get an extra $1 or $2 an hour. And so all of a sudden you had turnover rates increase at all the stores. So what does that do? Your execution within the store tends to diminish. You tend to have higher shrink rates because people don't know exactly how to watch the stores. I have to pay more. So there's a lot of ramifications to that.
Scott, this was awesome. Let's do it again soon on the retail sector. Scott Ciccarelli there of Truist. Coming up next on this program, Laura Rame of FS Investments and Victoria Fernandez of Crossmark. And as the UN General Assembly continues, Nobel Prize winner and economist Professor Joseph Stiglitz speaking at the Bloomberg New Economy event. Let's take a sneak peek.
It was. And indeed it was. Bush could look in the eyes of Putin and say, there's somebody I could trust. But I think the rest of the world didn't feel quite so comfortable. So, there will be an adjustment from hyper-globalization in both parties. But the difference is one in which I think Harris is committed to a global framework, working with what she views, with our partners, close partners of those, like our NATO allies, but also our partners in the South. And so it's trying to avoid a rupture and doing everything we can as we adjust our economy to embrace the rest of the world. So that's one. But the other one is, I think the way to understand Trump is his view of the world is a zero sum. And that means if the U.S. does better, other countries do worse, other countries do better. You saw this.
Two-day winning streak on the S&P 500 coming into Wednesday. Your equity market looks like this. We are lower on the S&P by 0.05%. The Nasdaq 100 down by 0.1%. The Russell of small caps just about unchanged. 60 minutes away from the cash open with your morning movers. Here's Manus Cranning. Morning, Manus.
Jonathan, good morning. General Motors is on the back foot this morning. Morgan Stanley downgraded the stock to underweight from equal weight. This is the second slashing of this stock this week. Earlier in the week, I brought you Bernstein's view. They may need more capital. But this is a much more holistic view from Morgan Stanley, which is the consumer is stretched. Inventories are on the upward trajectory. And, of course, affordability remains out of reach. So we're at some kind of a tipping point in the auto sector. The M&A action that Morgan Stanley thought was going to come through, those combinations just simply haven't played out. So 2 strikes on General Motors this week. Let's roll it over and talk about KB Homes. I almost want to move past the headline numbers, which is softening demand, mortgage costs are high, choppy demand in the summer. Boom. Boom. Look at refinancing today, up 20% last week after we saw those cuts. We've had 5 straight weeks of mortgage applications rising. So, okay, this is on the back foot this morning because simply their numbers are there. But if you look through the guidance today and you say, how does the housing market shape up into the back quarter? Maybe there's a release valve. I'll leave you with DoorDash. This has gone to overweight at KeyBank, $177. So you're looking at 25% on the upside. They're gaining ground in a lot of the verticals. I leave you with the concept of vertical integration at DoorDash. You can restock your mini bar. I didn't know many people had mini bars at home.
It's a New York City thing, Manus. Very New York City thing. They love the mini bar. Love the mini bar and the booze.
Are you
It's
New
just
York
not.
City?
Don't see it in the UK as much.
It's very much a United States thing.
Just letting Cranny know he's moved to New York. He's a recent, guest of ours here in America, and I'm just letting him know that
it's a big
relative to
thing.
London, bar carts are a big deal.
Yeah, bar carts. If you live in a house, you can build your own, and there are different designs.
Usually in houses in America, you have actual bars downstairs in the basement.
You sometimes have a bar, but you also have mini bars. I am not an expert.
You guys are
but
hanging
I
out
can
with Tom
decide.
Keene too much. He has like a proper.
I'm aware. Yeah, Tom Keene and friends.
All I can say,
With a lot
it's a
on
normal
only bar.
thing for the United States. Let's just
Thanks
leave
for
it there.
outing Tom Keene, Annmarie. That's good. All right, the S&P 500 touching a new record high with more data on the strength of the economy due this week. Laura Rame of FS Investments saying this: it's the ironic problem of overly optimistic economic expectations. When so much good news is priced in, markets can be rocked by any downside surprising growth, even an incremental slowdown to a more sustainable path. Laura joins us now for more. Laura, this is how we started the programme, and I guess we're going to end it this way as well. Do you think we're really vulnerable to one weak jobs print in the next few weeks?
Absolutely. I think markets are now laser focused on this job section. Unfortunately, we're condemned to be focusing on claims every single week now for probably the next quarter. The Fed is clearly in rate cut mode, but markets have priced in so many rate cuts, not just this year, but next year. And I think it's really going to be an issue for stocks because look at rates have fallen 100 basis points and equities are kind of still where they are. Price to earnings ratios are kind of haven't moved higher. So this is the issue. We've gotten just so priced for all of this good news and rate cuts, and I think markets are vulnerable here.
So where do you think that leaves the bond market cool at the moment?
I think we've seen the bulk of the long duration move because here's my outlook. We're going to have an incremental slowdown, growth closer to 2%. This is nothing radical on the growth front, but for equities where they are, for how many rate cuts are priced in, I think the bond market is due for a disappointment. Look at the 10 years up 10 basis points since the Fed cut rates. There's a reason for that, right? Because the data just are not showing us a recession. They're just showing an incremental slowdown.
Somebody might be listening to this and saying, but there are reasons to like things, even if you don't like the macro backdrop and how things are priced. In particular, the fact that stocks are less and less correlated to the macro backdrop, given that so much is tied up with NVIDIA and Apple and Microsoft.
There's no doubt that concentration is a big issue. And listen, the equity market is a reflection of the fact that the U.S. is still, the only game in town in the global economic slowdown. And that we're just seeing still, I think a lot of hope around AI. Rate cuts are priced in. But I think we need to differentiate between equity markets and the underlying economy. The economy can easily absorb an incremental slowdown, whereas equities, I think, are really increasingly reliant on this really aggressive rate cut trajectory to maintain valuations that are very high by any historic measure.
So, Laura, you don't like stocks, you don't like bonds. What do you like?
I like bonds. I just like looking deeper into credit, because when we think about the underlying economy, there's just so much, I think, still robust strength there. You know, valuations are overstretched in publicly traded markets. They're much more reasonable in the private space. And as rates come down, we're going to see an increase in M&A activity. We're going to get a natural lift in a lot of other parts of the economy. They're going to get some relief on maybe middle market companies that have been challenged by higher borrowing costs. I think there's a lot to like out there. It's just that we're really looking expensive in those publicly traded equity space.
Lara, appreciate the update. Lara Rain there of FS Investments, the latest on the market and the economy. This from Andrew Honhorst of Citi. The daily update. Jobs hard to get makes for hard landing. Take a listen to this. The percentage of individuals finding jobs hard to get is rising. This confirms that the rise in the unemployment rate is not good news about labour supply, but instead an indication that hiring is weak. An argument he's been making for quite a while.
And I understand that point, especially when we talk to people who study the companies and their earnings recalls. And basically, they're not hiring. So even if they're not firing yet, they are not hiring. And there's going to be job losses for attrition. Whether this leads to a hard landing is debatable. He's been talking about this for a while. That said, that is not being priced into the market. And that, I think, is reason why people are looking at non-farm payrolls as potentially another sort of chink in the chain fence. What's the
I don't know what you're saying. Carry on.
The chink in the armor.
Okay.
Thank you, control room.
Did the control room save you? Did they? Nice. Joining us now is Victoria Fernandez of Crossmark. That's a new one. You're getting help from the control room now. All right, Victoria, welcome to the show. The path of least resistance is higher for stocks. Where does that come from based on the economic data we got just yesterday morning?
Well, I think, it comes down to what you guys were just talking about when Lisa was saying a lot of the concern that's out there in the market, which I see as well in regards to the labor market, in regards to top line growth and earnings. It's just not being priced in. The market is really kind of on this high after this 50 basis point cut that, hey, there is a Fed put in play. Powell is not going to let this economy have any kind of a hard landing. And so the market is just off to the races. I mean, we've had some negative economic data, but yet we've had 2 new highs this week alone in the markets. And so I think you don't want to stand in the way of that train that's coming down the tracks, but I do think you want to be cautious. I don't think that the economy is going to do as well as the market is pricing in. I think it's getting a little bit over its skis, but in the near term, I think you want to ride that train a little bit.
Is the enthusiasm hanging, though, on one data point, just jobless claims and what happens with layoffs? Is that what this all hinges on?
Unfortunately, I think a lot of it does ride on that one number. I would hope that the market would actually look a little bit deeper. Y'all have been talking with me all year about digging under the hood in the labor market. Don't just look at that claims number. Actually, according to Challenger Gray and the data we're seeing there in terms of layoffs, it looks like claims will probably bottom in October and then start to move higher. And I don't think the market's anticipating that. Annmarie was talking about labor differential. We have been watching that so closely. You look at those numbers coming out of the conference board, it's 8 months in a row that number has been deteriorating. Quits are down, hires are down, temporary hiring is down. Those are all like leading indicators within the labor market. And one of the things we watch the closest, Jonathan, is cyclical employment. Don't just look at the regular payroll numbers. Take out the healthcare, the government, the education, and look at the cyclical component. That has been steadily declining. And in every soft landing we've had, that element has been moving higher, not lower. So I do think we need to look at some other areas of the labor market, not just the payroll number.
So what are you doing, Victoria? Are you basically buying gold and buying long bonds?
You know I love bonds, Lisa. We have that connection there. I'm a bond girl at heart. I think you do have to, like I said, participate in this equity market, even if you don't believe the long-term story that it has priced in right now. You want to partake in the upside of the market. So you look at some of the elements where you've seen some leadership changes. Look at financials. Look at some of the staples, healthcare. Those are areas we've been talking about for months. But yes, add some fixed income in there. Have rates come down a little bit? Yes, but you're still getting strong yields in the curve. So you want to move out a little bit. I know someone a minute ago said long duration is probably done. I would lock in some of those rates because you have heavy resistance at a 3.90 or 4% on the 10-year. And you also want to add some income generating components outside of fixed income. Look at covered calls, look at dividend plays, look at long short portfolios that are just trying to beat cash. Those are some elements that give you diversification because we think there's going to be a lot of volatility.
Victoria, how much do you give credence to this idea that we're seeing a tick up in the long end of the yield curve in terms of yields moving higher because there is a concern about inflation being stickier because of what the Fed is doing?
Yeah, I think it's twofold. I think you see that longer end of the curve moving higher, one, because people are pricing out the idea of a hard landing and they're all in on that soft landing. So you're seeing yields move a little bit higher on the long end for that. But it also has to do with the inflation component. Look, we have said for so long that that sticky part of inflation we think would keep the Fed from moving very quickly. I was actually surprised they went 50 basis points for that point alone. Look at prices paid in the PMIs this week. You had prices paid move up to 6-month highs, both on goods and services, and input cost on services were at 12-month highs. So I don't think we're out of the woods on inflation, and the longer end of the curve is reflecting that. And I know you were talking about mortgage rates earlier, and I hate to say it, but mortgage rates are highly correlated to that belly of the curve, that 5 to 7 year, and we're seeing that move higher as well. So I'm not sure we're going to get a boost from the housing market because of this.
Victoria, if you're worried about inflation, I mean, you sound a little bit like the Fed Governor, Mickey Bowman, who's talking about that she wants to take this measured approach because she's also concerned about inflation. Do you think then you're setting up for November to be a 25 basis point cut, or you think you're lonely?
Yeah, well, I actually thought for a while that we probably wouldn't see a cut in November. I thought the Fed would be much more patient and just going 25 in September and 25 in December. With a 50-point move in this last meeting, it leads me to believe that Powell is going to be a little bit more aggressive. So I probably would have been someone to dissent as well on that move and would have favored 25 basis point. But it looks like if the economic data continues the way it is, they will do probably 25 in November, 25 in December. That's 100 basis points this year. I think that's probably more than what the economy needs, but it's what the market is expecting. It's what the market is telling Powell they want. So we'll see if he gives the market what it's asking for.
But earlier you cited about that metric when it comes to jobs, how it does feel like it is getting much harder to find a job. Isn't that what the Fed should be leaning to? And wouldn't that lead you to a cut in November?
I think there has to be a balance. You know, the 50 basis point move that they had at this last meeting, I think is enough. Let that, it's going to have a lag, right? Just like hikes had a lag, cuts are going to have a lag. You're not immediately going to see someone say, great, 50 basis point cut. Let's go, you know, buy a house immediately. Let's go buy a car. It takes a while for that to feed through the economy. So I don't think they should be making these big cuts all right at the beginning. Let it work through a little bit, see where we stand. If the economy is expecting GDP growth of 2.5%, they're expecting strong earnings, and that's what they're saying right now with the equity market moving higher, but yet they want really aggressive cuts. The two pieces of that puzzle don't really fit well together. So I think taking a slower path on lowering rates is something that the economy can handle and would be better from the inflation perspective. Hopefully that allows the cracks in the labor market to slow, but we still have a good handle with the consumer.
Victoria, we've got to leave it there. Thank you. Victoria Fernandez there of Crossmark on why the path of least resistance for stocks is higher from here. I think investors, most investors, the bullish ones, would take that mix. They'd take a better growth backdrop with fewer, bigger rate cuts from the Federal Reserve.
Oh, absolutely, because ultimately it's the economy. Stupid, I guess, what people keep talking about, and that's what definitely people keep feeling in the stock market. I just wonder what counts as a good economy and for who.
Sure.
Because we were just talking about Walmart, and I think about, okay, well, they're able to also become a tech company and an advertising company and a data company and all these other companies that give their margins padding to allow them to compete much more aggressively and consolidate their market share. This is the type of thing that's going on. So can you bet on that, even if the broader economy isn't doing so great?
And now we've got utility companies establishing a stronger correlation with tech spend and AI. And data centers.
Exactly. So basically, you end up with a non-correlated asset to some of the traditional metrics, like bond yields that they traditionally were hinged to. It really creates a muddied backdrop.
What are we priced for? Lisa Shallett, Morgan Stanley. With the drama around the Fed's first rate cut resolved, the power of macro dynamics to drive markets through upside surprises has diminished. Goes on to say, yes, Fed actions have increased the probability of a soft landing for now, but markets have priced all of that and then some. You said this earlier this week. I said, what's the risk? And you said, what aren't we priced for? And what are we priced for? Right now, we're priced for soft landing nirvana.
Exactly. We're priced for this idea that the Fed can take the Austin Goolsbee side of things, cut aggressively at the same time that you get sustained growth. Can this Federal Reserve be preemptive in its cuts with enough time to get that put into place without necessarily causing a reacceleration up to 7,000, as one guest was saying, or potentially triggering some new wave of inflation?
We're going to play this from month to month, payrolls reports and payrolls report for the rest of this year. Equity futures on the S&P 500, just a little bit softer, slightly negative here, with an update on stories elsewhere. With your Bloomberg Brief, here's Yahaira Hekos. Hey, Yahaira.
Hi, John. Striking Boeing workers aren't interested in the company's sweetened offer to hike their wages by 30%. That's according to the Machinists and Aerospace Workers Union, which called the offer inadequate and disrespectful. The company angered the union by taking the offer directly to workers. Boeing tried to smooth things over by lifting the Friday deadline for workers to approve the offer after the union nixed the vote. Meanwhile, the Trump campaign says it's been briefed on, quote, real and specific threats by Iran to assassinate the former president. A campaign spokesman says a representative from the Director of National Intelligence told Trump about the plot. But there's no indication Iran's efforts are linked to the two recent attempts on the former president's life. And this is where our resident Mets fan, Mets owner Steve Cohen, is revealing new renderings of a proposed complex surrounding Citi Field. The plan with Hard Rock Entertainment would convert the stadium's parking lot to a gaming center and music venue called Metropolitan Park. Cohen's team says the project in total will create more than 23,000 jobs and invest $8 billion in Queens. The idea still needs approval from key lawmakers and New York Governor Kathy Hochul to proceed. That's your Bloomberg Brief. John?
Yahaira, thank you. Thanks for this morning. What do we think of that? Casino? Citi Field? Sound attractive to you? Enticing enough to make the trip out there?
Okay, hold on a second. You know what Citi Field means to members of my family. So I can't exactly, whatever they want to do, good for them. No, but don't make it a casino. It's a bastion of the American sport and the Metropolitans that can bring people together of all types to really enjoy.
As Yankees fans here in Midtown and Manhattan would say, it's an eyesore on the way to JFK.
I could say the same thing.
Okay.
Going up on the 4 train.
All right. Anyway. Up next on the program, setting you up for the day ahead, plus Bloomberg's Ed Ludlow on his exclusive with Meta's CFO. We'll catch up with him in just a moment. This is Bloomberg. The opening about 40 minutes away. Equities basically unchanged on the S&P 500, just a little bit negative on the S&P. We're down by 0.06. The sell-off in treasuries resumes. Yields are higher by 2 or 3 basis points. The 10-year 375.45. The calendar for the day ahead looks a little something like this. The UN General Assembly continues today. We'll get more Fed speak from Kugler at 4 p.m. Eastern Time. Tomorrow, another round of jobless claims plus earnings from Costco. On Friday, we'll get PC and UMich sentiment. Later on today, we'll get Micron reporting earnings after the closing bell. Let's catch up with Ed Ludlow for a little bit more. Ed, I know you've got a big conversation coming up a little bit later. I just want to kick off with those earnings. What are you and the team looking for?
Yeah, I think beyond the idiosyncrasies of what Micron does, it's a great crystal ball of what's happening across many industries in the world of technology, right? There's the AI bit. And as we build out data center infrastructure, high bandwidth memory chips that surround the GPU are really important. And what's so weird is they're proportionate. So for every piece of NVIDIA tech you have 7 or 8 corresponding Micron chips. But if you look at the stock, that's not the case. Why does it not get the corresponding equity market love? But also, Micron is at the core of very cyclical industries. And I think we'll learn a lot this evening, John, about the state of the world we're in.
Ed, one of the biggest stories, I think, of the last week and maybe the year so far, the fact that we've restarted a nuclear plant in this country and have pledged to give the energy to a single tech firm in America just makes me feel like this is the start of something much, much bigger that we need to pay more and more attention to. How big is this for you?
It's big because I think we don't really appreciate the number of parties involved. So nuclear power, yes. How many CEOs do you know that have a customer that will go up to them and say, I pledge to pay you for the next 20 years? That CEO of Constellation has that deal with Microsoft. How wild is that? But then think about all the REITs that are involved in the financing of literally bricks, mortar, concrete in data centers. And the energy component is relevant to that as well, because you have all of the cooling systems involved. That brings all the HVAC names. I think we're going to start to have a much bigger picture of what's happening here because of the sort of less attractive names in the cycle. And nuclear power is a big part of that story because we need to find the energy from somewhere.
And we need to understand exactly how this whole field is evolving, Ed, which is the reason why I'll be tuning into your interview later today with the Meta Chief Technology Officer. A real question about how they see AI functioning at a time when they've had to go back to their bread and butter, not necessarily the metaverse and some of their more moonshot plans.
Yes, but I've experienced something this week, and I've been reminded of something, which is my job is to serve the Bloomberg audience. What is the news? How does it impact the investor? But please remember that these are technology companies. And I think the reason that your audience should tune in this afternoon is that you will see a technology company that's actually pushing the boundary on hardware and software. That's all I can say for now. It is astonishing. And then the question is, have they done enough on the thing that they're going to show this afternoon to convince investors that they have a clear direction? It's astonishing, guys. So please tune in and all will be revealed.
For a moment, Ed, I was a little bit worried about you, that you'd put on one of those virtual reality headsets and had an out-of-body experience. But we'll tune in, I promise. Ed Ludlow, coming up a little bit later. Bloomberg TV, 4 p.m. Eastern Time. Ed's interview with Andrew Bosworth, the Meta Chief Technology Officer. You got thoughts?
Well, look, putting aside, we'll all be tuning into the interview. I am curious about how they're trying to think around some of the artificial intelligence aspects. You talk about the energy use, and I want to pick up on that.
Sure.
How do they end up making it more efficient? Because ultimately, it's going to have to come down to that. If you think about a company that's going to end up with a line item that's going to be funding a nuclear power plant, potentially, you're going to imagine that they have an incentive to increase the efficiencies of some of these neural pathways that they're creating. Basically, make it less energy intensive.
On the sidelines of the UN, I know we're joking about the traffic. Actually, AI has been such an important conversation. You think about this Microsoft deal. Sam Altman went to the White House to talk about the fact that they're going to need government help when it comes to powering and the energy need to really service these data centers.
Where is this energy going to come from? How many more of these stories are we going to see in the next 12 months?
Probably a lot. And you imagine that Microsoft isn't alone. Whatever Meta's going to announce later today, we'll find out. But, you know, maybe they'll also be...
What was that about?
No idea.
We'll find out.
I'm not sure where he was going with that.
There's quite a tease for that interview.
Yeah, well, you know, I could say, he's like, normally it's to serve the audience. I've had a...
He's had an experience.
He had an out-of-body experience.
Right.
And so hopefully we will find out why.
It's one of those reality headsets.
Yeah, the virtual, like an Oculus play?
Yeah.
I think that this felt deeper than an Oculus. This transported. But there's a real issue here about how it also limits the barriers to entry, because you have to imagine that a tech company has to afford to pay for said power. Again, this goes down to consolidation in the biggest players and how you sort of deal with that.
Tune in to Ed's Experience a little bit later on Bloomberg TV. Coming up tomorrow, Evan Brown of UBS, Jerome Schneider of PIMCO, Rio Tinto CEO. Look out for that. If you want a read on China, talk to someone who's got a big business in China. That conversation tomorrow morning is must-watch TV, and we'll speak to the NATO Secretary General, Jens Stoltenberg. Big lineup coming up tomorrow. Right now, your equity market on the S&P 500 just about unchanged. In the bond market, yields continue to climb. On a 10-year, we're up by 3 basis points, 376. And if you have to trade this, you have our thoughts. Euro dollar, 111.96. Just about unchanged on the session. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.